first of all, let's just approve the minutes from the last meeting way back in November. I'm sure everybody remembers it well. Is there any changes and or motions?
I'll make a motion to approve the minutes as submitted.
I'll second.
All those in favor, say aye.
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 All those opposed? All right, good. That passes. The minutes are done. Introduction of visitors. Anybody here that's not either on the board or related to Fpdr? Would you please introduce yourself? Okay, seeing none. Let's go.
Josh?
Yep.
We do have a sign up for the some agenda items. So there is someone, an attendee standing by.
Okay.
Joe Jankowski is standing by to testify.
Okay, great. Thank you, Kathy.
Mm-hmm.
Are there any public comments though?
No general public comments.
Okay. Then we can move on to action item number 1, the actual aerial valuation. I didn't say that very well. And levy adequacy analysis from Milliman.
And this is Stacy Jones, for the record, Finance and Pension Manager, still messing with my camera, which was working for my last meeting, but isn't working now. Anyway, the joys of life. I think I'm gonna have to restart my laptop. But I don't think Matt and Scott need an introduction anyway. and you just saw them a couple months ago, but they're here to deliver our legally required biannual plan valuation and also the tax levy analysis that they do in concert with that valuation every other year. And while I restart my laptop, I'll let Matt and Scott take it away.
Okay, thanks, Stacy. So this is Scott Prepper with Milliman. I'm gonna start sharing my screen and make sure that everyone can see it okay here. If you give me a moment. Okay, can you tell me if you can see that okay?
Yes, we can.
Yes.
Okay, great. So I'll get started and Matt will jump in here before too long. But this is our biannual update on the actuarial valuation and then our levy modeling that comes off of that. So just to jump right in, slide 1 for anyone who's following along, not on the screen. We completed our valuation as of a June 30, 2020 valuation date. As mentioned, we do this biannually. And then from that, that's our starting point for then a forward-looking model to look at essentially a 20-year forward-looking projection of costs under both the Fpdr program and contributions to organ PERS for Fpdr 3 members, and see what that translates to into a levy as a RMV value and how that compares to the 280 cap that we'll talk about a little bit later on. So this is meant to give a projection that can be used to quantify sort of potential volatility of some key moving parts, not all of them, but some key moving parts that would affect levy amounts in the future, and sort of see the range of projections out there that are shown under this model. Slide 2, most recent kind of set of these two work products we prepared was back as of June 30, 2018. And there haven't been a lot of changes that affect our model benefit provisions since that prior work, but there have been some updates to assumptions. So we discussed this a lot at the September board meeting. I'll note a couple things here, but happy to address any questions if anyone wants a refresher on them. Main ones to note is that we are using a different assumption, forward-looking assumption for Fpdr2 COLA based on the board's input. So now I'll get to the detail of it a little later, but that's a little higher forward-looking Fpdr2 COLA than we used in the last set of studies. And then a variety of other assumption changes were updated due to our experience study. So some demographic, retirement, mortality assumptions, and then some more economic assumptions like inflation, which was lowered, and the discount rate, which affects the valuation piece of it, but not the levy adequacy modeling. And then on the flip side of it, we're using updated both current real market values and projected sort of median forward-looking changes in real market value that affect the levy modeling, but not the valuation. The first section here, I'll go through the valuation in detail, and then Matt will jump in with the modeling after that. So one of the main uses for the valuation for Fpdr is really to tie into required financial statement reporting. So this June 30, 2020 valuation will be used as the basis for what's known as GASB financial reporting as of fiscal year in 2021 and 2022. Because of the pay-as-you-go structure of Fpdr, it's not used for things that sometimes actuarial valuations are used for, like really focus on the funded status of the program or pre-funding future benefits, determining actuarial contributions. So that, that kind of framework doesn't apply so much in this context. So evaluation by its nature is a very long-term calculation exercise. We're taking everyone from the youngest active members today and projecting a variety of assumptions over their working career to see what kind of benefit they accrue and then when they retire and how long they draw that benefit for in their retirement. So it's a very long horizon. We'll get to sort of what the benefit payment projection looks like here in a graphical way in just a couple slides. But it's worth noting that as of essentially the valuation date, the monthly kind of run rate of Fpdr benefit payments were in $11 to $12 million per month in our valuation model. That grows for the first about 16 years and then eventually gradually declines, but it doesn't get back to that sort of lower level in non-inflation adjusted dollars until late 2050s. But given that this is such a long-term sort of exercise, that the assumptions have quite an effect on the outcome you get out of it, as you may imagine. So I alluded to these just a moment ago, kind of at a high level, but this gives a bit more detail on the assumption changes that came out of the September 2020 discussion and the experience study. So discount rate, as I mentioned, affects the valuation. This is tied to a municipal bond rate. Like most bond rates right now, it's quite low relative to where it's been historically, and that has a big impact on the measured liability that we'll illustrate here in just a bit. The mortality assumption, we continue to keep this kind of in line with the Oregon PERS police and fire mortality assumption, since that's a bigger, more statistically credible public safety population to base it off of. That assumption, and so this one as well, now uses what's known as a Pub 2010 table, which is kind of the first kind of new modern public safety mortality table. Was published in 2019, so it's more specific to the populations that we care about for this plan. I mentioned the Fpdr2 COLA, and next slide actually will show the detail of what I mean by the 2 and the 175 assumption there. But then a variety of other assumptions were updated as part of the study, but even with all that, you'll see that they didn't dramatically change the picture of projected benefit payments in our work. So the as far as benefit provisions valued, while there have been some changes since 2 years ago, nothing that really is a big change in the modeled benefits that we show. But the assumption of future Fpdr2 COLAs does have an impact. As of the 2018 valuation, we used what was then being called modified PERS COLA, so 2% for service prior to October 8th, 2013, and 1.25% after that. In this current iteration, we're now using 1.75% for the post-October 2013 piece, which is what has been used most recently, adopted by the board. But it's worth noting that the assumption here doesn't dictate any future decisions. It's just a modeling assumption based on the input that we received from the board in September. So then with all those inputs, what happens in the valuation is we project out those benefit payments, we discount them back at the discount rate to get a net present value or a liability, and then according to a cost allocation method, separate that into what's known as the actuarially accrued liability versus normal costs of benefits that are assumed to be earned in this year and then in subsequent future years. And so that's what ends up going into the financial accounting liabilities. That kind of framework is the required GASB approach for this. Slide 9 looks at that first part, this projected benefit payment stream. So starting in 2020, the green bars here are the current valuation. So the projected benefit payments start at about 130, 140 million, grow to over 220, 230 million out there in the 2030s, and then eventually decline as Fpdr2 members are mainly retired, and then as more benefits drop off in the back end, and they're not replaced by while Fpdr3 members come in, they're not producing benefit payments out of the Fpdr system commensurate with that current working population or the earlier generation. The other thing to note on this slide, the dashed black line is really where this was in the prior valuation. So that's kind of a visual illustration of the point I'd made, that even though we changed a bunch of assumptions, even though obviously there's been some experience changes in the 2 years between the valuations, we're not looking at a dramatically different forward-looking projection of benefit payments. When we get back to the discounted value with a much lower discount rate, you'll see the liability looks different, but it's not because the underlying benefit payments are much different than when we were here 2 years ago. Slide 10 shows a variation of that same sort of projection, but this is what we're calling inflation adjusted version. So this is just a simple, if we use the long-term 2.25% inflation assumption and kind of back that out of each of those future payments, then you see it's a little different picture as far as what in sort of 2020 dollars these projected benefit payments look like. It still increases into the early 2030s and then decreases after that in sort of real terms, if you will. So then taking those projected benefit payments and discounting them back into the present value, into the liability, this is where you see the impact of the decrease in the discount rate. A discount rate that was 3.87% in 2018 has dropped to 2.21% for the current valuation. And because of that, even with a pretty similar projected stream of future benefit payments, the actuarially accrued liability increased from 3.3 billion to 4.46 billion, primarily a function of that lower discount rate. Also shown on here, so that's the number that actually kind of shows up, or a close proxy to that shows up in the GASB financial reporting. It's worth noting that the actual June 30, 2020 GASB reporting has already occurred based on a roll forward of the prior valuation. So a number very similar to this has already been shown and recognized. So it's not a surprise, but that is what the lower discount rate does to the accrued liability. And then when this gets rolled forward to year-end 2021 financial reporting, whatever the discount rates are at that date will govern how this gets reported at that date, but it'll be based off of the work done here first. Last slide in this section, just to sort of line item some of the changes from prior valuation to current valuation on the accrued liability. Again, you see that it really is the discount rate that's driving most of this. The assumption changes had some ups and downs. So the Fpdr2 COLA assumption added to our measured liability, since we're assuming larger COLA increases in the future than what we did in the prior evaluation. The mortality assumption decreased it a little bit, but definitely the one that stands out here is the lower discount rate is what's kind of driving the change in the measurement. So I'll pause there for any board questions before we move on. Okay. Hearing none, Matt, do you want to get started?
Sure, go ahead. Thank you, Scott. It's good to see everybody. Happy New Year. Scott summarized the valuation work that we did, which is really a snapshot of the liabilities as of a single point in time that informs a couple of the annual reports that we do for the city. There's something additional that we do in our every other year review of Fpdr, given the unique funding structure of the Fpdr 1 and 2 benefits that are laid out in city charter. And that is that we do a levy adequacy analysis. So, at the end of this section, which is about a dozen slide longs, we compare over a 20-year projection period under a wide variety of potential future economic scenarios, how robust and sufficient the $2.80 per $1,000 of RMV cap laid out in the city charter will be. But because Scott and I and Gary are actuaries and we like to show our work, we'll kind of walk through kind of the building blocks and how we get to the end result of the analysis. And we start with that valuation, those benefit projections that Scott talked about that we did for the valuation. And there's really two major subcomponents in our levy analysis, and those are laid out here. The first one is what we refer to as the pay-as-you-go cost subcomponent. This is the majority of the benefits for the 20-year projection period, the majority of the costs, if you will. These are the Fpdr 1 and Fpdr 2 retiree benefit payments. We also do include a margin in there and projections for death, disability, and disability-related medical benefits that we paid to Fpdr 3 members that qualify under the program, and a modeling for administrative and operating expenses for the Bureau. The second big subcomponent as a building block is levied on Fpdr 3 payroll. And these are the contributions to the OPSERP or Tier 3 of the Oregon PERS program, which is the pension program in which Fpdr 3 members, the majority of them, will get their benefits. These are more variable and less predictable than the pay-as-you-go cost subcomponent for a couple of reasons. One of them is that those costs are set by the PERS board. They include a charge for the value of the benefits currently being earned, which is referred to as the normal cost, but also a shortfall amortization for the PERS unfunded liability or unfunded actuarial liability, UAL. There's a UAL rate. And so those can really vary depending on what the board does, what happens with market conditions, what happens with assumptions, and even occasionally we'll have the Oregon legislature do come in and give a little bit of a thumb on the scale and can make legislative changes that will affect those benefits as well. The pre-funded cost subcomponent for the Fpdr 3 members also includes a fixed 9% of payroll contribution to the account balance-based IAP or individual account program, which is also administered by PERS. The Fpdr 3 members getting a side-by-side DB benefit from OPSERP and a defined contribution or DC benefit from the IAP. So, we're coming up here this year, later on the 15-year anniversary of the establishment of Fpdr 3 for newly hired members in the police and fire bureaus. And, our projection period is covering benefits paid by the levy from all members, for all members, be them Fpdr 1, Fpdr 2, or Fpdr 3. But those funding mechanisms for the tiers are quite different. The Fpdr 1 and 2 members, of course, they're getting funded by the levy. Their benefits are getting funded by the levy after they've completed their service to the city of Portland. The Fpdr 3 members are having their retirement benefits funded by the levy while they work for the city of Portland during their active working careers. So given this transition from a pay-as-you-go system to a pre-funded system, and the way that kind of works out with the charter reform from 2006, what that means is that we do have, for an extended period, transitional period, higher levies and higher near-term costs as we shift from that one type of program, pay-as-you-go, to a separate and different type of program, which is a pre-funded program. So, in terms of doing our analysis, the cost of any benefit program really to the sponsoring entities, in this case through the levy from property taxes, is really you look at the actual benefits paid plus the actual administrative expenses, and you subtract off actual investment earnings achieved. Well, what did the 2006 reforms do? It decreased FPDR3 benefit levels compared to what FPDR2 was being offered. That in and of itself kind of lowers the benefits paid portion of the equation somewhat. The other big change, but it's a long-acting one, is the pre-funded nature of the FPDR3 benefits. If you look at different studies around the country, the results are very similar to each other, that when you have a pre-funded pension program, somewhere between 2/3 and 3/4 of the benefits ultimately paid usually come from the investment earnings portion of the equation. So the reforms that did take place are going to significantly affect the cost equation shown in the slide here, but those effects are very slow and accrue very gradually over time. It really takes decades after the reform before you can really pronounce, material savings as having occurred from the effects of the reform of moving from a pay-as-you-go to a pre-funded program. So our levy adequacy model, we kind of have a bunch of different scenarios. We have thousands of scenarios that we model where we vary possible future market conditions, change from year to year. While it's not a guarantee of what will occur, it is a pretty robust sample set of possibilities for what might happen with the economy in the future on a couple of key items. The two factors in our economic model that drive our levy variability in future years over the 20-year modeling period are, first, changes in RMV, or the real market value, that applies to city taxes that are city properties that are subject to the property tax and the FPDR levy. The other big variable are what happens with Oregon PERS investment returns. There's a baseline forecast, but of course, investment markets are highly unpredictable from year to year and over the long term. And if we do have variations from the baseline, that is going to have an impact in terms of the PERS costs for that pay-as-you-go subcomponent of the levy. And that variability is going to increase over time as we have a greater and greater percentage of our FPDR payroll being with the FPDR3 membership. And of course, there can be correlation effects here. So if we happen to have a scenario that we model that has anemic RMV growth on properties in the city, then a lot of times that will be linked to an economic scenario where PERS investment returns are also poor. So those two kind of correlated effects on the components can kind of amplify each other and put more stress on the levy. And we have that sort of correlation effect of bad things happening all at once built into some of the scenarios in our model. So the basis for our model, we used the June 30, 2020 FPDR member demographic census. So this was the snapshot of what the active membership was for the police and fire bureaus, along with current retirees and beneficiaries receiving benefits as of June 30, 2020. The RMV as reported to us by the city economist, and it was the RMV that was used for the fiscal 2021 levy request. And then based on feedback and guidance from the city economist, for the first year's RMV growth at baseline, we model 0% RMV growth, which I believe would really be tied to some of the challenging economic conditions that we've had due to COVID around the country, and then median annual growth of 4% a year thereafter. And so while that 0% this year and 4% thereafter are our baselines, we do have a wide variety of potential RMV growth or shrinkage patterns in our model over time. We also had to model Oregon PERS investment returns. Our PERS modeling indicated an average investment return at baseline in our model of a little under 6% a year. That is below the current PERS board's assumption of 7.2%. The PERS board is going to revisit its investment return assumption here in 2021 and will be either reaffirming the 7.2% assumption, or in my estimation, and Scott's more likely, decreasing that assumption likely at its July meeting this year based on the outlook from its outside investment advisors. So in terms of, before we get to some of the charts, how do we interpret, or how should one interpret our levy adequacy analysis results? because we model 10,000 different scenarios, we're not showing kind of a single straight line. Instead, we're showing more of a probability distribution of what might happen. You know, here's a good situation, here's a bad situation, and here's kind of the middle of the road or the median situation in our model. We've got some credentialed investment professionals at our firm, and they specialize in economic modeling. So we had input from them in addition to the input from the city economists to build kind of internally consistent, coherent models. When we get to our graphs, the dots are really important to look at in each and every year over the 20 years. The dots really represent the median outcome. So if we ran 10,000 scenarios, we rank ordered them. Scenario 5,000 right in the middle is going to be where the dot resides. And then graphically, we display results from the 5th to 95th percentiles. So 10% of the results in our modeling, 5% on the top and 5% on the bottom, fall outside of the depicted range. Okay, and so while we did vary our results and our modeling based on a couple of really key and impactful items, which is R&V, inflation, and Oregon PERS investment returns, we didn't model all potential sources of volatility in the future. A couple of prime examples of that are listed on this slide. We, of course, could have changes in governing constitutional tax law for Oregon or for the city of Portland. Could be establishment of new levies. We could have demographic experience on the retirement side or retiree and beneficiary life expectancy different than our assumptions. We could potentially have changes in the Fpdr's workforce composition, if you will, and the how the Oregon PERS board sets its assumptions and methods, or how the legislature kind of mandates assumptions and methods on the PERS board has the potential to change things, and we didn't have those sort of variations built into our levy modeling analysis. Okay, so on to some numbers here. I'll get everybody oriented on this chart. I mentioned that we've got two major building block subcomponents in our levy adequacy modeling. The first and larger building block is the pay-as-you-go cost subcomponent. These are the projected benefit payments. Essentially, the majority of this is for Fpdr1 and Fpdr2 retirees and their survivor beneficiaries. This chart, moving from left to right, shows the results of our model year by year over the next 20 fiscal years, with the benefits for the current fiscal year being around $146 million, and at the median 20 years out from now, getting up to nearly $240 million. If you look at the median, that's about 2.5% growth per year. So that's pretty close to what our inflation assumption is. We've got a very modest variability between the 5th and 95th percentile for the pay-as-you-go cost subcomponents, because we feel like we've got a pretty good handle on a lot of the benefits for members already retired. And so for those members, the benefit amounts are already fixed. And the only real variability is on the mortality side, life expectancy. While we don't know exactly when an individual member will retire, we've got a big enough group that, kind of large group probability would say that, we're not going to see a lot of variance in terms of the death patterns and life expectancy patterns. And there can be a little bit, there's some linkage in inflation to our currently working Fpdr2 members. Inflation can vary in our model. That can affect pay. That can affect the benefits downstream. But again, the variation on this component of it is quite modest and just exhibits about 2.5% growth per year on a non-inflation adjusted basis at baseline. So that's the larger component. The smaller component, but the more variable one, is the second building block. These are the pre-funded cost subcomponent. This is really Fpdr3 levy-funded contributions to the Oregon PERS Defined Benefit OPSERT program and the 9% contribution to the IAP program also administered by Oregon PERS. Here we see more significant growth at baseline. We see something closer to 9% annualized growth at the median. This is coming because when we look over on the left-hand side of this chart in fiscal year 2021, Fpdr3 members are currently under 50% of overall Fpdr payroll. By the time we get to the right-hand side of the chart, they'll be more like 98, 99% of Fpdr3 payroll. So that kind of doubling of the payroll growth is one of the factors. The other thing that we see is a lot more variability here. In a really good scenario, the 95th percentile, we see that costs 20 years from now in dollar terms are not fairly different from what they are right now. That would be a scenario where we've had outstanding investment returns in the Oregon PERS program, and Oregon PERS rates for the Fpdr 3 contribution have become quite low. Alternatively, up at the top of the bars there, far out on the right, we could see costs go up much more significantly and be $229 million at the end of our modeling period. That would be a scenario where we've had very anemic Oregon PERS investment returns. And if those investment returns don't come close to the assumption, then what we will see in our modeling is a significant increase in the contribution rate on Fpdr3 payroll that's levied by Oregon PERS through the PERS board. So this is the second subcomponent. The prior slide was the first subcomponent. We put those two together in the next slide, and we get total requirements. So this is really just a summation of the prior two slides. It's the pay-as-you-go costs and the pre-funded costs. Everything is shown here on a non-inflation adjusted basis. And it shows a growth rate at the median, at the 50th percentile, of about 4% per year. Now that 4% per year, it's not really by design or anything, but the 4% growth rate at the median here from the beginning to the end of the fiscal period annualized is almost identical in every year but the first one to the city economist baseline for RMV growth. So that may be a little sense of where things may be heading with our levy adequacy analysis. This is a pattern at expectation, at best estimate, where we are going to see the total requirements, the total demands on the program probably move in line with RMV changes over the extent of the modeling period. But cognizant that there's no guarantee here given the variability, particularly on the Oregon PERS investment return side. So those components, the A plus B, pre-funded plus pay-as-you-go plus pre-funded, we take those and those are kind of our raw estimates, but then we've corresponded with Fpdr staff, particularly with Stacy, I think with input from economists as well. And we've tried to model a little bit of what Stacy spearheads for her work on the levy establishment and the budget analysis. So we make several adjustments and they work in opposite directions to come up with what we refer to as a final levy in dollars. They're listed here. There's a decrease to account for other revenue sources. There's two increases. There's one to reflect the effects of the discounts if we pay our property taxes in full in November, and delinquencies. You need to kind of goose that up in anticipation of some level of delinquency on property tax payments. And then there's also an increase that's done to reflect the effects of tax compression on certain properties in the Portland metro, the city of Portland area. So based on communications with Fpdr and with city economists, it varies a little bit by year to year. But in essence, we're kind of goosing up kind of our total requirements from our raw numbers by about 8 to 8.5% every year. There's more details on this in the appendix, and we'd be happy to answer any questions on that. So after we kind of do that goosing up to better reflect the process that's done in the budget plan, we end up with what we refer to as the final levy in dollars. This is really the same chart from 2 slides ago, adjusted upward by between 8 and 8.5%, again, depending on the year. And again, it's showing that same 4% annualized growth rate at median, if you will. And then we take these final levies in each and every year, and we compare them to the RMVs, which vary by scenario in our model. So if you could turn to the next slide, please. And convert that into kind of a final levy as a rate on RMV. And we do have the overlay that we have the $2.80 limit per thousand of RMV in the city. And what we have here is a pattern that at baseline, again, the dots, the 50th percentile, the levy stays reasonably steady over the 20-year modeling period. It's between $1.10 and $1.20. In our model, it peaks out closer to $1.45 or $1.46 about a decade from now, and then it starts to trend back downward in 2040. If we were going to extend the model out further at the median, there would be continued downward trend because we'd have lessening pressure on the pay-as-you-go subcomponent, since we wouldn't have any new Fpdr1 and Fpdr2 retirements 20 years out from now. All those members would be retired at this point. And importantly, you know, the levy line, the city levy, the cap, as written in the charter, is the orange line up here, $2.80. That's shown up at the top of the screen. We do have some scenarios, as we did 2 years ago, where the $2.80 levy limit is violated and exceeded in a year or two, or more than 1 year in the modeling, but that happened in less than 1% of our modeled scenarios. So while it is while there's still a level of risk there, we would characterize the level of risk of the $2.80 coming into play as being quite low, same as it was when we did this modeling 2 years ago. So despite, kind of a number of, significant financial events on the investment side, and with the economy and with, kind of flat RMV projections for this year, we're, certainly pleased to report to the board and the Fpdr membership that, we don't feel nervous or a high level of concern about the $2.80 levy cap being exceeded in the next 20 years. And so yes, that's good. Yeah, please go ahead.
In your models where it projected up over, were those like catastrophic events that you entered into those models, or were they, 10 years of decline growth, or that's wrong, or decline in the economy? I mean, what led to the spike? What led to the over 280? How extreme did you have to get that?
That's a great question. I will try to answer it, and then Scott and potentially Gary might want to pile on top. So our model has, when we have a bad scenario in our model, our bad scenarios at like the first and second percentile can be things like a single year return that you saw in 2008, where I remember the PERS Trust, where we serve as the actuaries, I think its single year return in 2008 was minus 27% in a single year. So that would cause a, kind of a significant spike in the PERS rates, because the fund, presumably at that point, PERS fund would have lost like $20 billion when they were expecting to earn money. So that's the level of thing that we're seeing conflated with what happens on the RMV side. So, we had a, difficult year, with the economy and with COVID and everything. And, the city economists is saying RMV is flat, but we have some scenarios, I think, Scott, where RMV, we actually decrease it in certain situations in the model.
Yeah, that's true. So since we model a distribution around that, we would actually see some scenarios with decreasing real market value, and especially when those kind of line up with the low returns. I think in the appendix, if I can get to that here, we show some detail about the variation that is built into, for example, the PERS returns. And you can see that here the sort of worst scenarios shown over a 15, 20-year period. We're talking about cumulative average returns that are 0, 1, 2% over this period. And so a 1% return would be even worse than that on the PERS side of things.
Here we got the RMV on screen right now, Scott.
Oh yeah, okay. And so here's the RMV, right. So there's the RMV. Sorry, the PERS is the next slide, where 0, 1, or 2% on those low return scenarios, and 1% would be worse than that. And then this is the RMV version, where in the near term, are at the 5th percentile kind of bad scenarios, we've got negative RMV growth. Over the long term, over a 20-year kind of compounded average, it's not negative, but those would have some big negative years in there that would be driving it. And at the the even further outliers that aren't shown on this graph, the 5% that aren't shown there, would be even worse.
Yeah, Scott, Matt, I mean, I guess the way that I try to think about this, and tell me if I'm wrong, is that what you really need is kind of a snowballing effect from one year to the next. And you need a situation whereby we've got, let's say we've got property tax appeals that don't show up on the assessments and summaries, right, that we get, and they kind of feed into the next year. So we under collected one year, then we got to collect more in the next, and get sort of a snowballing effect over multiple years that leads to higher liabilities in a current year that would push sort of the demands on the levy. But generally speaking, this looks at what I would have expected it to look like. But I think that that's sort of how I was thinking about it, and correct me if I'm wrong, but that you kind of need multiple year problems to get to a situation whereby you can't catch up, and you're kind of playing catch up, and in doing so, you're putting pressure on the levy.
Yeah, I think that's true, and it's happening on both sides of the equation, as as you're saying there. So the RMV is is depressed, and the pre-funded costs for the Oregon PERS system are going up because of low returns in the Oregon PERS return investment portfolio.
Yeah, I think that's a fair characterization, Josh. And really, you can have a really, of course, you can have a really, Oregon PERS rates are set every 2 years, and you can have a really bad investment return biennium with material losses, and we've got that modeled. Granted, we have 5% of the scenarios are even worse than what we show on the bottom end here. And if that's happening, that's going to have a kind of a challenging effect on the variable cost, the pre-funded subcomponent, and then the fact that we've got the levy structure here, and that bad RMV movements are likely to be correlated with bad investment returns. It's almost kind of it almost amplifies it in the modeling analysis.
This is Kathy, picking up on that whole theme a little bit. Help me understand if, yes, this is a really aberrant year, and maybe 2021 will be as well. And that's a good time for us to be thinking about how sensitive this could be, or the probabilities that we could get into trouble. And it sounds like it still remains a pretty low risk. But let's suppose we, 3-4 years down the line, we're still feeling, rents are going down and assessed values are flat or not increasing at all. And PERS returns are not very impressive as well. So let's suppose we're stacking a few years of this together. What's the solution for the plan, if any, to mitigate this? I mean, can you increase the assessed value? I mean, can we increase the amount that they're taking as revenue? This is not a funded plan, so I'm just trying to think. There's no kind of advance that you can do to collect in the event that things go wrong in perpetuity, right? You just have to watch for it and hope it doesn't get there. Is that true?
Yeah, maybe I'll start off with the answer, and then it's possible that Sam or Stacy might want to weigh in on their roles, kind of from the finance and director side of Fpdr. Is in kind of one of the scenarios you articulated there, Kathy, like thinking about 4 years out, and it's been a really crummy 4 years. So if we go, and Scott, maybe you could go, for example, to illustrate what this means. Like if we go to slide 38 in the presentation, Scott, give you a sense about what a bad scenario would be. There we go. So here's 38. So if we move 1, 2, 3, 4 years out, we're talking about, like, in the bad side, hey, our RMV growth, and I have to get the air quotes up here because it's negative, annualized RMV growth of negative 1.4%, negative 0.8%. So RMVs have fallen, not even stay flat for a period that's getting to, at this point, to half a decade. And then if you move on to the next slide, Scott, 39, and on the same side, Oregon PERS investments on an annualized basis, again, in a bad scenario, the Oregon PERS returns annually have been negative 2% or negative 1.5%. So it's like, the PERS fund was expecting to earn money, but instead they've lost several $1 billion each year for 4 years running. So we do have those kind of like correlated and really bad events. But if we, and Scott, I'm going to make you drive all over the PowerPoint here. But if you go back up to slide 27, I think it is. It's like when we look at our 4th year scenario, in a bad scenario for the 4th year, the levy 4 years out, the levy on the bad end is still like $1.46, $1.53, something like that. So it wouldn't be welcome, it wouldn't be comfortable, but at least in the narrow lens of, is it going to cause a problem with the levy? It's not. The reason for that, from kind of a mathematical financial perspective, is thinking back to the start of the levy analysis and those 2 big components, the pay-as-you-go subcomponent, which is the benefits for the FPDR1, FPDR2 members and their survivor beneficiaries, and then the pre-funded. The pre-funded is really the variable part. That FPDR1 and 2, the pay-as-you-go, it is ballast in terms of the levy analysis for this program. The majority of those folks in that 4 years from now are retired already. We know what their benefits are going to be. And so, while those would be horrific economic headwinds to deal with, they would not change very much or at all the majority of the costs funded by the levy, if you will. So it'll raise the levy rate, but not to disturbing effect.
Great, thanks. That makes sense.
Trustee McLeod, this is Stacy. Let me just address really briefly your question about what would we do if we ever did hit the cap, which I don't spend much of my time worrying about this anymore. But there were times when our levy analysis was showing maybe we had a 10% chance of hitting the cap. And so then I did think more about what we might do in the early 2030s if that were to happen. And I mean, there are a number of options. One may be to change city charter to change the cap. One would possibly be to issue pension obligation bonds so that we're essentially borrowing money now and paying it off in the future by keeping our levy rate really high, like right at that 280 point, maybe for 5 years or 10 years or 15 years in order to pay down those POBs. There are legal and financial issues with that. But we have looked into some of those worst case, what would we do if that were to happen? And if that were to happen, it would be in the early to mid 2030s.
Okay, thanks.
This is Trustee Lehman. I had one question. On the RMV growth from 20 to 21, you put in 0. Is that an estimate, or was this something is that the year we're in right now, or do we have any preliminary numbers, or where did that 0 come from?
It came from me. It is an estimate. The assessment date for 2021-22 was January 1st. And so what we're finding is that we've got conflicting, depending on the class of property, we've got conflicting things happening. Residential property has actually done pretty well. It's going to go up more than 3 or 4% in RMV probably. But the property downtown in particular is something we're going to have to watch. And so for collections purposes, we're fine in this fiscal year. It's next year that we're going to have to kind of navigate as we go, because the problem is just because bills are issued in October or November doesn't mean that there won't be an unusual number of appeals that will happen, especially on those commercial properties. And talking with building owners downtown, they're anticipating doing exactly that. And that won't show up until much later in the fiscal year and will change the RMV ultimately to the extent they're successful. So we may be hitting a moving target a lot of next year, which is why we lowered sort of our longer term expectations for RMV. But at this point it is, I mean, admittedly, it's a lot of it's a guess. But the data are in the books. It's just a matter of them processing it over the next several months to get to October, when we'll find out sort of where we landed, until we get to a point where we're understanding better about appeals and delinquencies, because there undoubtedly will be property tax bills issued to companies that either can't afford to pay or no longer exist. And so those two factors are something we haven't dealt with, quite honestly, to this level, I don't think, in a prior recession. And so we're gonna have to navigate it as we go a little bit. But they'll bounce back to some degree. But the office space in particular is going to be problematic, because those are over 5-year leases. So that's likely to be a slow burn over the next half a decade at least. There's a bunch of older CEOs that are realizing they probably don't need as much space as they did before, because they're still getting stuff done with everybody working at home. So that's sort of the expectation going forward, is that it's going to be a little bit lower. But residential property has done pretty well. They're still building multifamily. We're still attracting migrants. We were third in the nation, the state was at least, and Portland did pretty well too. And United Van Lines, net inflows of people. So we're suffering a little bit in the near term, as everybody is, and we've got some other issues around national publicity and those kinds of things that we're not quite sure how that's going to sort itself out. But people's habits are pretty sticky, and we're still the lowest cost on the West Coast. If you want to move out west, you can choose Boise or Spokane if you want, but if you want to be closer to the beach, you're gonna end up somewhere a little closer. So it's to be honest, we're kind of guessing at this point, more so than we normally would be. But I think we're hedging towards a pretty slow recovery on that angle. But as the levy adequacy shows, it's not going to matter dramatically unless we're way off. So I'm not terribly worried about it in the context of what we're discussing right now.
Can I ask you what percentage of the RMV is, I guess, driven by commercial as opposed to residential?
Residential is about half, and commercial is about a quarter, a little less than a quarter.
Which leads me to the question, what's the other quarter?
There's industrial property, there's personal property, there's centrally assessed property, which are like utilities that cross county boundaries. And there's recreation. There's a bunch of smaller ones. There's multifamily is one. But remember, commercial also includes our commercial corridors like Division and Williams and Mississippi. And those have done okay, relatively speaking. So they'll be offset a little bit. And we're still seeing building, in Slabtown and a little kind of corridor within about 20 blocks out of downtown. Essentially, we're still seeing a lot of apartment buildings going up. So we'll see some benefits to this, but it's going to be, I wouldn't expect a new office building or a new hotel being built in Portland, maybe even for the next decade. I think that in all likelihood, that's going to keep slowing.
Okay, thank you very much.
So I don't think we've got any other slides in our presentation. So I think happy to field any other questions, but we appreciate everybody's time and attention, and it's good to see all of you.
Yeah, I have just a handful of really trivial questions. Just reading correctly. So it looked like the COLA assumption for future COLA changes was a little bit over 2% of the liability increase. Does that sound about right?
Any other questions for Mountain Sky?
Oh, I think Kathy just asked one. So Scott, if you can call up the presentation, the slide with the changes on the accrued liability, Kathy, is that the one that Trustee McLeod you're referring to?
Yeah, we'll do. Here, let me share that. Okay, this is the slide you're referring to? You can see it, all right?
Yes, I'm looking at the report, but yeah.
Oh, okay.
Yeah, that looks, so yeah, about 78 million. So that's about 2+% change, right? Something like that.
Yeah.
Okay, and that feels instinctively about right is kind of really what I was getting at. Right. The other changes, I just want to make sure I'm reading it correctly. It looks like there was a plan experience loss from retirees living longer than assumed before. And then the assumption change to the new mortality assumption, this PUB 2010 table. But if I'm reading this correctly, that's a reduction in the liability. So we had, so the new table on average is assuming shorter life expectancies, but over the past year or two, it was just kind of an anomaly with low mortality. Is it okay?
No, Trustee McLeod, that's exactly right. So the last 2-year period, we actually did have a loss. We had fewer deaths than projected under the existing table that we had. But given that that's only a 2-year period and this is a smaller population kind of to benchmark versus the overall state kind of safety population, we still felt like it was worthwhile sticking with that bigger, more credible group and moving to the public safety specific tables that are now available from the Societies of Actuaries, which Oregon PERS moved to. So we'll monitor it, and if long term, if we see a pattern like that, then there might be a further adjustment that we talked to you about compared to to the existing table. But right now, the 2-year experience on a plan of this size just was, that's more noise than we'd be comfortable basing it off of.
Okay, I just want to make sure I was reading that correctly.
No,
that's perfectly reasonable. And then I also wanted to ask, if I remember correctly, there was a flurry of police retirements in August 2020. I take it those are not reflected in this.
Correct. Since those happened after the valuation date, those aren't reflected. So those members who retired in August would have still been active members at our valuation date. Clearly, we don't have built into our assumption to assume 60 people retire in 1 month. And so, we may well see when we get back in a year or maybe even 2 years, maybe retirements overall over the period will be higher than what we had. But it is worth noting that, that was a 27 pay period month. It had been a long time since there had been one. Over the upcoming biennium, so between this and the next valuation, there's only 2 of those dates, and that's the one that is going to have had the most pent-up demand. So over, a 2-year period, we assume 100, a little over 100, I think, actives will retire, and about 65% of those will go out on a 27 pay period date. So, I mean, it could be that over the 2-year period, even though it all happened in August of 2020, that we still end up pretty similar to assumption, but it's certainly not, not going on a proration of that right now. It was a lot to happen early in the biennium.
Yeah, agreed. And there was obviously a lot of other social events going on as well that motivated that. So, but just in general, that's not expected to have any really material long-term impact on things in terms of that timing. Okay.
No, so it's more important for the, the short term, how different is this year's payment requirement versus what might have been expected. But as far as for the longer term, those people, we didn't expect them all to go out in August of 2020, but we expected them to go relatively soon, one way or another, under our assumptions.
Okay, and that feeds just perfectly into my very last question. That was in the slide that you showed with projected benefits by year, or at least it was across the bottom for maybe the norm for the revenue projection, the revenue analysis. The first year projected benefits, and that was something like 146 million.
Oh, okay.
Payout. Let's see if we can find that. So,
yeah.
And I was looking for, 146. Okay. And I was just comparing that to the projected benefit chart in the report in section 2 on page 5. And the first year on that one, fiscal year end 21, is like 138. So there's a comment in the report that says that those projections don't include Fpdr 3. So is that maybe the difference? Is that this chart here for this total pay-as-you-go includes Fpdr 3, but the one in the report doesn't? I just was trying to...
I think there's administrative expenses as well.
Yeah, I think it's the footnote here, administrative and operating expenses, that we group in here for the levy modeling, but those wouldn't be built into the benefit payments shown in the report chart. I believe that's a big part of it.
Okay, that's it. Thank you.
All right.
Okay.
Such great questions, as we would expect from another actuary. Thank you, Trustee McLeod. It's great to have an actuary on the board. Any other questions for Matt and Scott?
Chair Harwood, I believe there was a Mr. Jabkowski had signed up for public comment.
Great, I was just about to ask you. Mr. Jabkowski, welcome.
Hear me okay?
Go ahead with your testimony.
Yes, can you hear me okay?
Yep.
Okay,
yes.
I was going along trying to get some of my thoughts together here, and it's easier if I just read something I have written here very briefly, if I can read it and then ask the question at the end of what I say here, if you don't mind. And I know before I say this, and this is from the bottom of my heart, I know some people don't want to see me here, and some people may not want to see me here, and believe me, I don't want to be here, okay? Honestly, I don't want to be here, but there's something inside of me, this tenacity, consistency that I have inside of me. It's an innate trait that I have in my makeup that keeps me here. And it's also my brother, sister firefighters and our relatives.
It's 3 o'clock.
Oh, and also it is also the Portland police officers and firefighters that I'm speaking for on behalf of those people there. Anyway, please allow me to, first of all, congratulate Trustee Hudsinger for becoming the new president of the Portland Police Association. So congratulations to you for becoming the president. I think they're in good hands now. I'm excited to see that, because what I know you're ready for being on the board. I know you possess integrity, and I know you have a heart. I know you have a soul, and so they're in good hands right now. So kudos to you and kudos to them. We're lucky to have you there, and we're lucky to have you on the board too. Hopefully you stay on the board. In the past, presidents have stayed on the board in past boards. Next, I want to say is that I want to clarify one point too, that at the July 2015 Fpdr board meeting, Attorney Nelson Hall clarified that the term disability under FPDR was clarified to mean that it is our version of workers' compensation. So anytime you hear the word disability with FPDR, what I understood from Attorney Nelson Hall is that it's our version of workers' compensation, period. So that's our version. Without that, we have nothing. So we have to have some version, and under Oregon law, we're allowed to have that, as Nelson explained, have our own system, as long as we have a system that's similar to what they have there. So that's our version of that. Next point I want to make is that the ETOB process is a complex process, and with actuary assumptions that come down to comparing apples to apples, oranges to oranges, terms I've heard mentioned several times over and over again. And since the passage of House Bill 1849, 1941, two facts have never changed, even though there's been changes in the laws and changes in people and makeup and groups and everything else. Two changes have never happened, and that is that the law required a disability retirement, a service retirement pension and a disability retirement pension. Those two aspects have never changed. There's been death benefits, there's been post-medical things have all changed, but those two aspects have been consistent all the way through and are consistent today with the current law of House Bill 2280 that says you have to have those two things plus the post-medical benefits, which is a newer change. Having said that, I know I have to go to the voter all the time, and having said that, the charter allows a way it says under section 5.403 that if the city, that if the board is aware of something, or if the city council is aware of something that is not in violation of the law, and they give examples, state law, federal law, social security, etc., they have the power to fix it without going to the voter. So it's not a complex system to fix. The solution is there and it can be fixed. It just takes having conversations to fix it. And then I'd be gone too, actually. So, and having said that, so the power is there in section 5.403 to fix it. Now, my question, at the time the question was initially asked, and you probably know where I'm going already, it was initially brought up by Trustee Hutzinger, raised the issue first, and then it was followed up by Trustee McClard, and then followed up by Trustee Lehman. They all answered that question, and to Mr. Larry B. and Mr. Prepanu. And so they asked a question there, and when they asked their question, it was finally followed up and narrowed down by Trustee McClard when she asked, how did FPDR pass the ETOB test? But when a member says that there was no disability retirement, and having said that, at the time, Mr. Larrabee, in all fairness to him, and they weren't asking for you to answer that day, they were asking the question, kind of tabling that question, and you were not prepared to answer that question today. I don't know if you are today or not, but if the question was answered already, great. Where do I find it? If it was answered already, please tell me where to find it. I'll go find it and leave you alone and won't bother this question ever again. I'll go read the answer. If it was not answered, I'm raising the question again, because to me, if the board has the respect, to ask a question, then we have the respect to answer that question, whenever it was. And then when they asked me questions, I came back and answered them questions to the board. So I'm asking the question again. If it was answered, I'll go find the answer and leave you alone. Stop right there. If it was not, I'm asking the question again. How did that happen? And if you're not prepared today, I understand that. Will there be a time you're more prepared to answer that question? And today you talked about numbers and figures and actuaries and government accountability and all that sort of stuff. It all ties into your role as an actuary. That's why I brought the question back up today. Hopefully I didn't speak too fast. If I do, I apologize. I'm on a lot of medications, and one of them is an amphetamine, unfortunately, and it makes me a little more hyper than I normally am. So I apologize for that. But I tried to read it as I had written here. So Mr. Larrabee or Mr. Prepanu, if you have an answer to that, or direct me to where the answer is. If it's been answered already, great. I'll go find the answer or see the answer and end it right there. If not,
so I will. I'll strive to give an initial answer right now, but it won't be a definitive answer.
Fair enough.
Is that I think the issue of how the FPDR benefits were valued under the law, under the governing statute, and under the governing Oregon administrative rules as developed by the Oregon PERS board would be summarized in the most recently conducted ETOB test that was published for the FPDR program, which I'm going to say, working from memory, was probably about a decade ago.
2010.
Thank you.
Right.
Yeah.
You produced.
Right. And in terms of some of the legal interpretations and how the rules will be established for conducting the next ETOB test, I think that'll be determined. Really, the ETOB test ultimately, I feel like the administrative oversight comes from the Oregon PERS board, and presumably they will go through they'll go through a public rulemaking and administrative rule establishing process aligned in their view with statute, including an ability for public comment before the next DTOB tests will be conducted, which I think those may be occurring next year if I've got my mappings right from the governing statute.
Correct. Next year, 2022. So yes, you're correct. So that's the answer then. Wait till next year.
I think that the answer is that there will be I don't want to speak for Oregon PERS director or board, but given the way that staff usually handles things there, I'm presuming that they will kind of go in front of the board with a rulemaking process to establish the rules for the conducting of the next DTOB tests. And they make full consideration of both the precedent of existing Oregon administrative rules and any statutes, including changes to statutes that have occurred up to the time the test is conducted.
Okay. Well, I know, in fairness to you, the courts have supported your decision because the courts have told me several times over and over again that the PERS, the PERS board spoke, and they're supported by the by the law, and so. But the PERS board only acts upon your information. They don't act upon anything but your information. So it comes down to your information as being the sole source of proving the facts. So.
I guess one quick comment I'd have, and it's potential that somebody else from Fpdr may want to step in as well, is that whilst we certainly do actuarial work for Oregon PERS and PERS work for the PERS board, some of the things you mentioned really are almost legal type interpretations and issues, and we're not a law firm, and we do not serve as external counsel or internal counsel to the Oregon PERS board. They are advised by, I think, both external counsel and the Oregon Department of Justice. Correct. You're right. You're correct there. They are advised by that. The legislation sets the rule, sets the boundaries, and then the board use the administrative rule process to go ahead and implement those there. But the bottom line is they don't make a decision until you give them the data. And I understand where you get the data from. In your report, it says, first of all, if you have any questions, ask you. So I'm asking you. In your report, it very clearly says that. And second of all, it says that you acquire the data from Fpdr and from PERS. So I understand you're putting apples and oranges in, and you're getting these things out. So somehow along the way, the information came across somehow that these benefits are there when they're actually not there. I mean, I'll just say right off, the benefits are not there. Because if they were, I wouldn't be here. I'd be off worried about healing and focusing on my healing, because I have a limited amount of time left in this world. I know that. My time is ticking. So, and I'd rather be spending it with my family and other ways. But I need to get this clarified first, whether it's if not now, then 2022 for sure. I will be there trying to get it clarified. So.
All right.
I do want to go away. I do want to go away.
Thank you, Mr. Jumkowski. Kathy, is there anybody else signed up to testify? Kathy?
No, there's no one else signed.
Okay, great.
Thank you for the time. Thank you for the time. Thank you very much.
Thank you. So at this point, I'll accept a motion to accept the actual evaluation and levy adequacy analysis.
I'll make a motion to accept the report.
I'll second it.
We'll just do it this way. Any opposition?
No.
Great, it passes. We'll move on to the adopted budget for next year. And I believe that's Stacy's realm.
That is definitely within my realm. Thank you, Matt and Scott and Gary. As always, it's great to see your guys' faces. I never see your faces anymore. It's great.
Thank you.
And I just think everybody should look out their window, and we should have a quick poll on whether it's snowing wherever you are.
Agreed. It looks beautiful.
I know it's snowing. I want to go out in it, but I see my kids out there hoping that it sticks. But
it's sticking like crime at 900 feet in Northwest Portland, and the road is gone. So yeah, be safe.
It takes nothing to snow Matt in where he lives. It's
Stacy, this is Kathy. Claude, before we leave Mr. Jimkowski's comments, it's a very complicated topic. The rules of the test are prescribed not by the actuarial firm, not by your legal counsel. They're prescribed and PERS is in charge of that test, as I understand it. So the ins and outs of how it operates are really, there might be a little bit of interpretation needed, but by and large, it's apply the test as it's been prescribed. And that may not be getting to his main question, where he began his comments by saying, the law requires that there be a disability retirement benefit and a service retirement benefit. So I think we've addressed this before about the fact that while a benefit may not be labeled a disability retirement benefit, that doesn't mean that it is not being provided during disability prior to normal retirement. So I don't really want to get into it today. It's not today's agenda item. Our item was to hear his comments today, but I do feel like we may want to circle back at the next meeting and just see if we can provide a concise response to that question. What do we feel the law requires in terms of disability or service retirement benefits? And do we feel the plan provides benefit in compliance?
And
Catherine and everybody, we had discussed pre-COVID that we were going to have a work session with our attorneys, both Lauren and Franco, to address those issues and explain them to you. So I recommend that at some point I'll work with Josh to see that we can get, because I think it was agreed to that we want to hear from the attorneys first, then the board can discuss, what direction to go from there. So if that's still the plan, Josh and I can work out with Lauren and Franco when we want to hold that session.
I think that would be great. Yes, last year's events got in the way of many, many things, and this was them. And I just want to make sure we follow earlier effort to make sure we understand what is required and how the plan is complying.
Yep, it would do that. So Josh and I will put that on our list to talk about and to see what we can arrange for you all.
Thank you.
And Kathy, just, oh, sorry, go ahead.
That's okay, go ahead, Stacy.
Oh, no, I was just going to say, to very briefly answer your question on the first piece, yes. Anybody who's concerned about how the ETOP test is conducted has to take those concerns to PERS, because PERS is in charge of that testing. And it's actually very intensely prescribed how that test is to be conducted. I think if you hired 12 different actuarial firms, you'd probably get darn near the same result. So maybe exactly the same result. So it is, yes, that test is conducted by PERS, and the methods for conducting it are prescribed in a lot of detail. And then the second piece is for Lauren and Franco to address at another time. But previous boards have been asked the same question, and they have heard that answer from Lauren and from Franco that we are certainly not doing anything illegal. That we are providing benefits as required under all applicable laws and the city charter. But we can talk about that in more detail at a future work session.
I would just like to say that, and we're obviously premature. This is not going to happen until 2022, but that'll be here before we know it. And I don't really know how we actually memorialize it, but I would like to make sure that the board is kept up on when this happens again, and we want to be informed about it. We want to know what's going on, so we can answer these questions and we don't have to keep going through this. We need to, if we have a role or a possible role, we need to be involved. I know everybody keeps saying it's up to PERS, but if it's about us, then we obviously need to play a role. I don't think PERS would do anything against us on purpose. It doesn't matter. I think our role is to make sure that we're protecting and holding up our end of the bargain for our members. So, and I don't know how we make sure that we're part of that, if there's any part to be in, whether it's just to be a role of being informed of what's going on. But I don't want it to go, the next ETOB to go by and not know that it happened and not know the process. So I just want to, for the record, I want to make sure that we are involved to whatever extent we could be involved in the future. So
I have not been in this position since an ETOP test was conducted, but I don't believe we have any role of any kind. It's their test, and the test is conducted for this purpose. And as I understand it, this purpose only, which is if we fail to provide benefits that are equal to or better than PERS, then our folks got to go in PERS, or we have to change our plan benefits. One of those two things have to happen. So it's just there for the state of Oregon to say to the city of Portland, you're good, proceed, or you're not good, either put all your people in PERS or increase your plant benefits. And that is the purpose of the test. And Matter Scott can correct me if I'm wrong, but we could, we can stay informed to the extent the PERS board permits that, but we don't have a role of any kind.
I think the only correction or amendment, no, not really correction, amendment I might have to that, Stacy, is the fact that PERS does through their processes of establishing these things, they will establish typically an administrative rule to administer the test, and their administrative rules go through a public hearing process, posting for comment, that sort of thing. And so then the city's role would, if in my mind, would be that we typically, although, I assume it still happens online, that the city usually has a representative or two that attends PERS board meetings and keeps track of things. And so that's where kind of the opportunity window would be to both have awareness of the timing of the process, the content of the rule, and the opportunity to comment if the city saw fit.
Yeah. Okay, so I think that would be the time that I'd appreciate that we were kept informed, whether it's through government affairs or whoever's working on this stuff, that we're get a report and we're ready for it and we know what's going on. I think communication is very important, whether we get to play a role or not. I'd rather know up front when it's happening, and if people want to, I'm sure it's a public meeting. If people want to attend, they get a chance to attend virtually or in person. I think we should just be transparent, have it available when it happens, and that we're posting it, and our board knows when it happens, and we follow the process. So we're educated and we know how it works and we know what it is. So we're not just sitting here wondering what we're even talking about.
I fully agree there. Jason, we'll make sure that we are on top of everything that's happening, keep the board informed of what's happening when the ETOB starts, and if there's any administrative rules to be put out there. So we will let you know, keep you fully updated as it progresses.
Thank you.
Mr. Jimkowski, I see your hand is raised. You have 30 seconds. We need to move on.
First of all, in defense and support of Mr. Larrabee and Mr. Preppernew, they only get the information, and no disrespect to Ms. Jones, they get the information from Fpdr. It says it right in the report, it's very clear. It says we gather our data from Fpdr. So Fpdr does have a role, first of all, okay? You do have a role in this. You're not totally blind by the whole system. Fpdr does have a role in the system. Second of all, PERS board operates and they follow with the legislation through the Oregon administrative rules. So once again, they're mandated or required, or the decree is to follow the law. So, and the law is very clear on these benefits. Otherwise, I wouldn't be here. Thank you.
Thank you. All right, let's move on, Stacy, and head on to agenda item number 2 here.
All right, it is that time of year where we got to talk about adopting the budget. Let me just pull up my slideshow. All right, we'll try to be as brief as we can. I'm just going to do a quick sound check. Can everybody hear me okay, or shall I put my headphones in? Anybody?
You're good.
Am I good? Okay.
Yep.
I just want to make sure. Sometimes the sound quality is not the best without my headphones, but I kind of hate them, so I'm gonna leave them off. All right. So it's time for our annual budget adoption. January is always my favorite board meeting of the year, especially in even numbered years when we get to hear about the valuation and the budget. But what we're going to talk about today is the staff recommended budget for the upcoming fiscal year, 21-22, which is the period July 1st, 2021 to June 30, 2022. And then we also have a forecast for the 4 years after that, kind of a draft budget, just to make sure that we are, thinking adequately ahead, looking around the bend at what is coming up for us. I think all 4 of you who are here today are really familiar with the Fpdr budget and the process. You've all been through this before. So I'm not going to provide quite as much detail as in the past, but of course, stop me or, while I'm talking or follow up with me on any specific questions as we go along here. And just a reminder that the board does have the exclusive authority to adopt the budget. Unlike all the other bureaus at the city, council is required to levy a tax adequate to fund the budget that you adopt. But we do participate in the city budget process. So we'll turn this budget into CBO, to the city budget office this Friday. And our budget will be included in the citywide budget the mayor proposes in late April or early May, and it will be included in the citywide budget that council adopts in June. And then of course, council will levy our tax in June as well. I also want to point out that there is a more detailed forecast document that is behind your presentation in your board materials. It's attached to it. Just a lot more information in there, more tables, a lot more narrative. I'm not going to go through that today, but it is there as a reference. And I just want to remind you of that. So you know that I love to torture people with lots of numbers. Even better, I can make it my opening slide just to set the tone. You've seen this before. I do like to start with this. I don't expect you to read every word of it, but it is a way for a place for you to refer back to if you want to see the whole budget and the whole forecast in one place. It does give you an overview of everything. So going across the top, we have.
Stacey?
Oh, yes?
You're not sharing anything.
Oh, I'm not? Oh, shoot.
Nope.
Sorry, guys. Okay, hold on. I must have stopped sharing when I moved my thing here. All right, am I sharing now?
Yeah, you're good.
Yes. Okay. Oh my gosh, I've had more trouble today, I'll tell you what. So the forecast slide, that's what you all can see, right? I saw Jason giving me a thumbs up. He's like right in the corner of my window, so I'll just keep looking to Jason and he can tell me if I go astray. So this does give you everything on one page. Going across the top, you'll see actual revenues and expenses for the most recent year that we have full year data for, 1920. And then you'll see the adopted budget for the current year, our current projection for the current year, and then the most important column, the staff recommended budget for 21-22, and then the forecast for the next 4 years. And then in the last column, you'll see the percentage change over that whole 5-year period from our current year projection to the last year forecast. So you can see how things are moving over that 5-year period. And then running along the left are resources on the top and all the various flavors, those come in. And then underneath that, requirements, all of our expenses. It's just another word for expenses. And then along the bottom, our total budget net of tax anticipation notes, since we issue and repay tax anticipation notes in the same year. So they sort of just go in and come out. It inflates the size of our budget. So that's kind of a better view of how big our budget really is. And then running along the bottom, the percentage change in our budget each year. And you can see that 7.3% is the average annual growth. That's the very last number in the very bottom right corner. And that's actually very similar to our experience over the last decade or so, and probably similar to the growth rate we're going to see over the next decade or so. It's a high growth rate because we're phasing in that pre-funded pension plan. At the same time, we still are fully operating a pay-as-you-go plan. But it's at least over the 5-year period, that growth rate is very similar to what we have seen in the past. This slide is the same as the previous slide. I'm just trying to extend your torture. No, not really. But this has at least fewer columns on it, so it's a little easier to see what's happening with the budget we're recommending. And this one also has a column that shows the percentage change from our current year projection to next year's budget. So you can look at just a year over year change. And you can focus a little bit easier on the budget year. So before we launch into any of the details, let's spend just a couple of slides on the big picture. Last year at this time, we had a couple of kind of big picture, issues, more outstanding issues that were unresolved and things that were just coming over the horizon. And some of those things have now resolved in one way or another. So I just wanted to update the board. The first is that the 2019 PERS reforms that the Oregon legislature enacted withstood legal challenge at the Oregon Supreme Court. And so that happened in 2020. So we have some certainty about those PERS reforms. And the fact that they were upheld should at least somewhat slow the growth in PERS contribution rates over the next several years. They're still going to grow, but it will hopefully slow the growth over what it would have been. There are a lot of factors in setting those rates. And most of the factors that are out there are bigger than the factors that were addressed by the PERS reforms. But we'll see. That was certainly the intent of the reforms. Also, last year at this time, none of the city's sworn represented staff, which is nearly all of our members, are represented. None of them had settled labor contracts for the current fiscal year, and now they all do, which gives us a lot more certainty going into this budget year. However, I mean, I should point out, however, that the PPA contract, the Portland Police Association contract, which is the largest in terms of our members, will expire again very shortly. The previous contract was just extended 1 year and now expires on June 30 of 2021. I'm sure I do not have to remind Trustee Hunziker of this. But all the other contracts are in place. We don't know if the city will attempt to reopen the other contracts, but at least we have some degree of certainty moving into the budget year. And then finally, as you know, we have an updated plan experience study that you all accepted last September. And so we updated many of the assumptions that underlay the budget on kind of a nuts and bolts level. And I just kind of listed out some of the big ones. I'm not going to go over them again. But all of those things were sort of, just on the horizon or unresolved last year. And some of those things have been settled in a year of a lot of things continuing to be unsettled. At least some things did get resolved. Clicking on to what is different this year. So those are the things, we just talked about the things that were unknown at this time last year. But I also want to talk about what is different this year, which as those words come out of my mouth, that seems like a hilarious thing to say, given that everything is different now as compared with a year ago. But we'll limit ourselves to just talking about how everything being different is impacting the Fpdr budget. So the first is overhead revenue. One of our non-property tax sources of revenue is when police or fire contract their services out to third parties, they charge wages and they also charge an overhead rate, part of which is an Fpdr specific overhead rate. So that revenue that comes to us mostly comes from the Police Bureau. It's normally around $1.5 million. And the vast majority of that revenue comes from one police contract, which is their contract with TriMet to provide transit police. But the Police Bureau pulled out of their contract with TriMet on December 31st, 2020, as you may have seen in the paper. So that is money that we've lost half of that revenue for this year. We'll lose all of it going forward. So now we're going to need to get that money from the tax levy. Small potatoes in the scheme of things. $1.5 million is not a lot in the context of a $200 million budget, but it is something that's new and worth mentioning this year. Retirements. Retirements are always uncertain. We do the best that we can to project them, usually based mostly on actuarial probabilities, which are in turn based on age and years of service. But given just the colossal number of retirements this year, and the fact that we will have no 27 pay date months next year, we've kind of decided to go off the actuarial reservation, and we are just budgeting for 20 retirements next year, 10 at police and 10 at fire. But I feel like that's a very uncertain thing, especially at the Police Bureau. So I'd be lying if I said I wasn't nervous about budgeting for that low level of retirements. I think it's the right thing to do. But there's still a lot of organizational and budgetary change going on at police right now. And that may result in some members deciding to call it a day earlier than they had planned. We may see higher retirement levels at police than we've budgeted for. Then, of course, we have uncertainty related to COVID, or else it's at least COVID adjacent, like the economic downturn. That uncertainty falls into two big categories for us. The first is tax delinquencies, which we've already talked a little about in the actuarial presentation. We normally assume that that about 4.5%, we're gonna not collect about 4.5% of the tax we levy because of delinquencies. But this year and next, we've increased it to about 6%. Is that too much? Is that too little? We don't know. We don't know for sure if that's gonna be right. The second impact of COVID and COVID adjacent issues is a smaller impact in terms of dollars, but a big impact in terms of service to our members and our members' lives. And that is COVID related disability expenses, which have really gone up dramatically in the current fiscal year as members have either tested positive for COVID or had to quarantine because of COVID exposures. And then of course we pay their wages while they're off work, quarantining or recovering. So we do expect that that will trail off here over the next couple of months as our members get vaccinated. Will we be right? You know, again, we don't know. Next thing that is really different this year is that we are going to have a lower ending fund balance than we've had in a long time. Ending fund balance on June 30 is beginning fund balance on July 1st. So that's why it matters for our next year budget, how we end this year. And we normally end in the $15 to $20 million range. This year, we think we're going to be at about $8 million. So 2020 took a toll on our fund balance, just as it did on everything else. And I talk through some of the reasons on the slide, and we'll talk about those more as we move along through the presentation. There we go. All right, so let's first, let's do a little bit of digging around in the weeds now that we've talked about some of the big picture things. But let's start with expenses. As usual, this is usually the order in which we talk about things, but it is a little backwards. Normally you talk about how much money you have, and then you talk about how you're going to spend it. But at Fpdr, we talk first about how much we need to spend, since most of our expenses are just non-discretionary. And then we talk about how we're going to raise the revenue to meet that need with the tax levy. So this chart is showing what we recommend for the expense budget for fiscal year 21-22. You know, and it's got the expenses broken into their various components. The pie is, of course, bigger this year. You can't see that in the chart because our expenses grow every year. But the division of the components is really about the same. PERS contributions are a little bit bigger slice of the pie, and Fpdr pension benefits are a little bit smaller slice of the pie. You know, that's going to keep happening every year as we phase in the PERS covered membership and phase out the Fpdr covered membership, but not that different. Fund expenses are a little bit more than usual, a little bit larger portion of the pie this year because we are recommending that we set contingency, fund contingency a little higher next year, given all the uncertainty we are swimming in. But as you can see, Fpdr 1 and 2 direct pension benefits still really dominate our budget. And then the second largest expense by is Fpdr 3 PERS contributions. And then after that, we get into much smaller numbers. So let's talk a little bit about the most important thing in our budget, which is Fpdr 1 and 2 pension payments. As you saw in the previous slide, this is about 70% of our budget right here. And this chart is showing you actual expense for Fpdr 1 and 2 pension payments in 1920. Projected spending in the current fiscal year, what we recommend is the budget for next year, and then the 4 additional years of forecast expenses. As has been the case for many years, I mean, the main story here is just that costs are going to go up in our pension payment budget as Fpdr2s continue to retire and as they make up a bigger and bigger proportion of our retiree pool. The Fpdr2 pension benefit is more generous than the Fpdr1 pension benefit, and their wages are still growing every year. So every sort of class of new Fpdr2 retirees has higher pensions than the class that came before. So that's, as always, you know, that continues to be the underlying story with this budget. But the 4 main things that impact any pension budget, that impact our pension budget and any pension budget are the annual cost of living adjustments for the existing retirees, actuarial assumptions that we're using to guess when people are going to retire and how long they're going to live and what pension accrual choice they're going to pick and things like that. The pension amounts for new retirees and the number of new retirees. So those are the 4 main things that flow into the pension budget. For the first one, for the retiree COLAs, the board chose the COLA last year to be that 1.75%, 2% blend. And this budget uses that method, doesn't bind the board in any way. You know, we used it in the valuation, so we're also using it here in the budget. Of course, the board can still do what it likes every July 1. The actuarial assumptions we touched on again in the valuation presentation. But we do have the updated experience study. And so we have used that to underpin the pension budget. Overall, that resulted in slower expense growth for a variety of reasons that I can go into if anybody wants. And then pension amounts for new retirees this year, the sort of new class of retirees this year, are much lower than we thought they would be because there was no cost of living adjustment on July 1st, 2020 in wages for PPA members. There was for PFFA and PPCOA, but since PPA members are most of our members and most of our retirements, that meant the starting pension amounts were not quite as high as we initially expected them to be. But we will have a double whammy next year because PPA is supposed to get, that COLA was deferred from July 1st, 2020 to June 30, 2021. So they are supposed to get that COLA on June 30 and then supposed to get another COLA, a new COLA on July 1st, 2021. So they'll kind of get 2 years worth of COLAs in 1 year. So pension amounts will be higher next year for the new class. But we also expect far fewer retirees next year. So anyway, we project that pension costs next year, we project that pension costs this year will be about 7% higher than last year, which is not that different from our usual growth rate, but to the degree that it is a little bit higher, that is all about the number of new retirees, which you've all heard about ad nauseum, kind of the story of 2020. But the real story of 2020 is the pandemic and protests and wildfires, but at Fpdr, it's also about retirements, which are definitely related to all those things. So let's take a look at retirements. And let me pull up a little bit of the detail here on my graph here. Sorry. Sorry, guys, give me 1 second. Okay. So I think this is just a really fun graph for the board to look at least once a year. This graph shows actual retirements in red for fire and in blue for police and in purple for the total, going all the way back to 06, 07, which was our previous high retirement year, through the fiscal year ending in 20, fiscal year 1920, which was our lowest year that we've had, at least on this graph. And you can see then where we start with projected retirements, which are more shaded starting in fiscal year in 21 and then running out through the end of the 5-year forecast period, that we think we're about to follow up our act last year of having the lowest number of retirements ever with our highest year ever in fiscal year in 2021. We think we're going to end the year with, we're almost certain that we're going to end with more than 100 retirements this year. I'll be very curious to see if we beat the 06-07 record of 105. But as you all know, we had over 60 retirements in August, and we have had 33 in January, because January 2021 is also a 27 payday month. As of today, we've had 33, and we're still counting. We still have the rest of this week, so we think we'll get up to about 37 total in January. And that, of course, that doesn't count the disability and vested retirements, which are less driven, which aren't really driven at all by the timing of 27 pay dates. And then we always have a few who go in June. So I think we're easily gonna be over 100. But it'll be interesting to see where we do wind up. But that is the major reason that you're seeing pension expenses jump this year and again next year more than they have in the past, as those new retirees come on board this year and then then it grows again as they get a full year of pension benefits next year. But note that we do expect a very small number of retirements next fiscal year, which is kind of harkens back to what Scott and Matt were talking about, well, you know, over the 2-year period, we're not really seeing a lot more retirements than we would have predicted based on actuarial techniques. It's just the timing of those retirements within the 2 years. We're seeing a lot in August of 2020, and then many in January of 2021. So let me actually pause there before I move on to first contributions, because I'm just droning on and on. Are there any questions? No? Everybody good? All right. So moving on to PERS contributions, which, as you'll recall from that little pie, are about 14% of our budget. They are growing. And the first thing I have to do is apologize because you have the wrong chart in the materials that were distributed last week. We accidentally copied the chart from the Fpdr 1 and 2 pension payment slide. So what you're looking at on your screen is the correct slide. What you have in your materials is not the correct chart anyway to show the growth in the PERS contribution budget. But this budget, again, it's showing actuals from 1920, what we project we're going to spend this year, which is a lot, and where we think this budget is going next year and in the years after. So this is growing quickly and exponentially, which is exactly what it should be doing, and as it has been doing for a decade or so, and will continue to do for at least another decade. What drives this budget is the number of Fpdr 3 members, which goes up every time police or fire hire anyone, the pay levels of those Fpdr 3 members, and PERS rates. So it's at the end of the day, it's really just those three things. And the first two of those things go up every year. We have more Fpdr 3 members every year, and they make more money every year, if only because of cost of living adjustments and wages. But also this group is still moving through the pay scale in the police officer and firefighter classification, and now they're starting to get promoted and they're starting to get premium pay assignments. So the growth in their pay is considerably more than just annual cost of living adjustments. And the PERS rates go up every 2 years because they are set biennially by the PERS board. But there was big growth in this category in the current year. In fiscal year 2021. Of course, we don't know exactly where we're going to wind up, but right now we're projecting almost a 25% increase in this cost this year as compared to last year, which is even crazier than it sounds when you consider that there was no increase in wages, and there was no increase in cost of living adjustments for PPA members. There's been almost no hiring at police, so we haven't really increased our Fpdr 3 population significantly. And there was no increase in PERS rates this year. So the story there is overtime. We pay PERS contributions on overtime, and overtime has really spiked at police and fire because of the protests and the wildfires last fall, and the pandemic. And so that is what is really driving the growth in the current year. For next year, we do expect almost 15% growth, but that's more in line with what we normally see. And it's actually less than we expected at this time last year. And that's because PERS rates are not going to grow quite as much as we thought. PERS rates are going to increase. Right now, we pay 29.16% of wages for every single Fpdr 3 member to PERS. And next year, that will go up to 31.72%. But last year, we thought it might go up to as much as 34%. So it's a little bit slower growth than we thought. But we do still project, as of right now, that PERS rates are going to be up in the 39% range by the time we're at the end of the forecast period out in fiscal year end 2026.
Stacey, quick question.
Yes.
Since I'm not a PERS member and don't know these things like the rest of you, is all compensation, including overtime, included in PERSable wages?
Yes. So we pay contributions on total wages, and then the way overtime is included in calculating the PERS benefit varies by tier, but it is also included on that back end in calculating the pension.
Thanks.
Mm-hmm. Thank you, though. At least I felt like that interrupted me from my droning. As I mentioned, police hiring is way down. Police hasn't hired anybody since June of 2020. And they probably won't get any new folks in place until the summer of 2021. And they are telling us that they don't plan to replace everyone who has retired in August and now in January. So we are also projecting a little bit slower growth next year because we don't expect police hiring to be as much as we thought it was. So bottom line is we had a lot more growth in this budget item this year than we were expecting. At least, a year ago, but we think we're going to see slower growth in this budget item next year than we were expecting initially.
Stacey, can I piggyback on that question that Trustee McLeod asked? So the overtime is figured in for rates. Is is it more about the IAP contribution that jumps those up, or is it more about the PERS rates when you're figuring in overtime?
Well, we pay it on all of it. So we pay the 9% IAP contribution is paid on overtime as well as regular wages. So when a police officer or firefighter works a bunch of overtime, they're also putting more money into their IAP because we pay the 9% on total wages. But it's also the defined benefit portion of the contribution. We also have to pay that on total wages. So it's both. Does that answer your question?
Well, yeah, I know that the OPSERT members, which that's the only people we're paying on through our through the fund, right? We don't pay on any tier 1, tier 2, and I know that the OPSERT members, the figuring in for their retirement, the defined benefit portion is very limited from what I understand compared to the old way of doing things. So I was just curious how much of it is really in the PERS rates as opposed to the IAP portion.
Well, from our perspective of just paying in the contributions, we get a rate, that 32, I forget what I said it was. Well, take the 29.16% is this year, 20.16% is for the defined benefit portion of the OPSERT benefit, and 9% is going into those members' IEP. Of course, we know that a portion of that is being redirected right now. So we're paying 9%, but the full 9% isn't going into their IEP. But on the back end, when those members retire, now we're into the world of PERS. So I have to say that I'm not the PERS administrator. And so I cannot tell you with absolute certainty how that calculation works, but I believe that they're given the average overtime of their job classification in their calculation. And I do not know, I assume that's specific to the employer, but I don't know that for sure. So I assume that when a police officer retires as an OPSERT member, he gets the average overtime that a police officer at the city of Portland earns figured into his calculation. And I think they did that to prevent overtime spiking in your final 3 years.
Yeah, and I'm just curious how do you have individual rates based on Portland's, I guess, overtime, what our members are working in overtime, and then so our rate is based on us, or is it a statewide thing? Because I haven't seen or I haven't heard of anybody in that tier that has retired yet, and I've always been curious how their pension is going to be figured, because I know in our pension there's no overtime, doesn't make a difference.
Right.
And I know that in tier 1 and tier 2 and tier 3 PERS, I'm under the assumption that they're all different on how I think the tier 3 has been reduced compared to how tier 1 was, and maybe tier 2 also, but I'm also curious how that affects rates. So anyway, probably can't answer it all today, but it's probably
interesting. Yeah, interesting. All interesting questions. I do know that our rate is specific to us. We have our very own rate, and so our rate, the rate that we're paying, the 29.16%, is not necessarily the rate that the city of Eugene is paying or Portland Public Schools is paying. So I can tell you that. Much. But beyond that, I think we're a little bit too much into PERS administrative territory. But I can try to follow up on some of those specific things. Yeah. And the tier 1, tier 2, I think that what they get is their actual overtime in their pension calculation. Whereas the tier 3 folks get that average.
Okay, thank you.
So PERS contributions. Any other questions about PERS contributions before we move on? Disability benefits are the next major category of our budget. Reminder that this is about 4% of our budget. So let me kind of orient you to this chart that you all know I love because I put it up every year. But this chart shows you all the different kinds of disability benefits. So there's a different color for every different kind, disability and death benefits, I should say. And again, we're looking at actuals from 1920, projected spending for this year, what we recommend for the budget next year, and then the forecast beyond that. But you can see how the different types of disability benefits are behaving. And the first and most obvious thing that this chart should tell you is that there's been a big uptick in short-term disability benefits in the current year, in our fiscal year end 21 projection. So that is the impact of those COVID claims that I was talking about. You can see that medical payments, which are the yellow line, also went up, but they didn't go up quite as dramatically. And Kim could probably speak more to that, but I think that's because COVID claims have time loss components. They have wage replacement costs while folks recover and quarantine, but they don't have really high medical costs. But still, we also have an increase in medical costs for this year. So this is where you are really seeing COVID claims at fire and police impacting the budget. But note that we do expect that to go back to normal, except for medical, which we don't really expect to dip a lot because most of that increase in medical is not driven by COVID. But for short-term disability, we expect that to drop back down in next year's budget.
One quick question with regard to 21. Aside from COVID, is some of that increase related to injury during the summer and various riots downtown?
You know, I would probably let Kim. Kim probably has a better top of the head assessment of that.
Not as much as you think. We certainly have had a lot of officers injured, firefighters as well, but the numbers that resulted in a disability benefit and medical treatment wasn't as extensive as I thought it might be.
Well, that's good to hear.
Yeah.
Thank you. Thank you.
Okay, some other things to point out. Any other questions about the COVID claims and impact on the budget this year? You know, it's not a large part of our budget, but pretty dramatic increase, and we're not out of it yet. As Kim can tell you, we're still seeing not as big of, we're seeing, we hope, the beginning of the decline in those claims. The other thing that I want to point out is about long-term disability, which is the blue line with the triangles. And you can't see it, it's off this chart, but long-term disability has been declining for many years. And over the last couple of years, we've talked about how, you know, it started to decline following the 2006 reforms. But the last couple of years, we've talked about how we think we kind of had bottomed out. It was about as low as it could go. There are about 25 folks on long-term disability right now. But that is expected to increase over the next year or so, not COVID related, but we think we're going to need to add a couple of new members to the long-term disability roles over the next few months or maybe year. So beyond that, everything except medical costs really just grows with wages, because all of these things are tied to wages except for medical cost, which we have growing at medical cost inflation, which we've estimated at 4%. And funeral benefits, which are the little green line with the little dots bouncing along the bottom. It's hard to see in this graph, but those are actually growing quite a bit too. And that's because more Fpdr2 members are passing away now, and they have a much higher funeral benefit than Fpdr1 members. And it's not part of this slide, but I did also want to mention that the $10,000 that you all approved last November for the police wellness program to return the rapid response team officers to patrol is also part of the budget for next year. We know some of that is probably going to get spent this year and some next year, but we have included it in the budget for next year, and we will revise this year's budget in the spring budget adjustment if we need to. Any questions about any more questions about disability? All right, administration, the next piece of our budget. So this is about 2% of our budget. And if you are interested, there is a detailed line item administration budget, as always, on page 13 of that forecast document that is in your materials just behind this presentation. So if you want to see every single item, you might want to flip to that. But this pie chart, again, shows you this is what we recommend for the administration budget in fiscal year 2021-22, and how it breaks out into the various categories. Not surprising that personnel is more than half of administrative costs. We have 17 positions at Fpdr, which is unchanged for many, many years now. And although the board and Sam can control the number and type of positions, compensation of those positions is mostly controlled by the city. So let me talk a little bit about that. In the current year, salaries were frozen for all but the 4 represented Fpdr employees. We have 4 district council of trade unions employees at Fpdr. Everyone else is non-represented. So those 4 folks did get a cost of living adjustment just recently on January 1st. But pay was frozen for everyone else, as it was for all non-reps throughout the city. And also everyone at Fpdr did furloughs this year, and those furloughs range from 40 hours to 80 hours, kind of depending on the pay level of the position. So that happened this year and really held personnel costs down, which was the intent, obviously, citywide. And then we have been told to budget a wage cost of living adjustment for July 1st, 2021. That will be 1.6% if it comes to pass. But I think that's very much up in the air. We were told to budget for it. I don't know what will happen. And then we were told not to budget any other kind of merit raise or anything like that for our non-represented staff. All of our represented staff are at the top of pay scale. So I think we're kind of just waiting to see what comes out of the rest of the budget process for those pieces. But we have kind of just followed the mayor's guidance on what to budget for personnel. I did put more than usual in the personnel contingency line because I want to have enough funds to cover whatever may come to pass. Because I think there's a lot of uncertainty about what will come to pass with the personnel budgets this year. And one new thing this year that I did just want to mention is a new statewide payroll tax to fund Oregon's new paid family leave program. So that tax is 1% of wages up to $133,000 a year, 0.4% funded by the employer, us, and 0.6% funded by the employee. And that starts on January 1st, 2022. So kind of halfway through this budget year. So once that's fully implemented, it'll cost us about $10,000 a year. And of course, employees will also be paying out of their paychecks for that. And also, just like in the sworn population, we also have PERS rate increases for our staff next year. We're in the general service category, so our rates are different, but we will also have PERS rate increases. And elsewhere, outside of the personnel budget, there's really not a lot to report. The two biggest items in this elsewhere in the administrative budget are the office lease and legal services that we purchased from the city attorney's office. And we actually have just to give you a sense of kind of the things that are in the rest of the bucket, but we actually have a slight decline from the current year in spending in all those other categories, mostly because we're going to be off cycle for actuarial costs. We're not going to be paying for evaluation and an experience study next fiscal year like we did this year. Are there any questions about the administrative costs? Next up is this slide really just shows the cost of living outside the general fund. Living outside the general fund is a great place to be. I think the benefits outweigh the costs. Chair Harwood is smiling, but there are costs for living outside the general fund. The first is fund balance. We have to maintain one. We can't overdraw our checking account, so to speak. So in between, I already talked a little bit about how our fund balance at the end of the year and beginning of the next year is usually in that $15 to $20 million range. In between, it can be as much as $135 million or as little as $1 million. Just to give you a sense, our average daily balance last year was about $63 million. Anyway, so we have to maintain a fund balance. We have to keep enough money in the fund to make sure that we don't overdraw as we're paying along. And we do, of course, issue tax anticipation notes to help us with that at our lowest point. I already mentioned that we expect to have the lowest fund balance we've had in many years on June 30, 2021. And this slide talks about, the things I have already mostly discussed for why that is. I mean, basically, we are going to take in 2.7 million less in revenue this year than we were planning at the start of the year. And we're going to spend about 2.4 million more than we were planning to spend. And that'll do it. If you take in less money and you spend more money, you will have less money at the end. And that's why you guys pay me the big bucks to tell you to give you these great insights into financial behavior. But part of what we'll be doing with our tax revenue next year is rebuilding fund balance as we kind of recover from this year. The second thing we have to do is we have to maintain our own fund contingency because the general fund does not want to hear about it if we have unanticipated expenses. So this is kind of like that envelope of cash that you keep in your sock drawer in case anything goes wrong, or hopefully you keep it in an online savings account that is earning decent interest, which good luck finding something like that these days. But normally we keep fund contingency at about, under normal circumstances, about 7% of operating expenses when all is really well and perfect and most things are known. But we have had it up at as much as 10% in really high risk years. I'm recommending that we set it at 9% of bureau expenses this year. I think that we are in a pretty high risk environment. We have a lot of different things going on, and we do not know how all of those things will shake out. But I also think that this level of contingency, which gives us 16.1 million in the kitty to use if things don't go our way next year, I think that this level of contingency is enough to ride out a variety of things not going our way. If, for example, we have substantially higher property tax delinquencies than we're budgeting for, or if we have much higher pension expenses because a whole lot of police officers that we weren't expecting to retire. If something goes wrong with tax anticipation notes in the municipal bond market, this is enough to pay pension payments for a whole month. So I think it will cover the loss of all of our non-property tax revenues. I think this is enough contingency to cover a variety of bad things that could happen. It's not enough to withstand all of those bad things happening at once. But I also think that's pretty unlikely. And the last thing on the slide are just other fund expenses, which is general fund overhead, which is us just contributing to citywide costs like the Emergency Coordination Center, for example. Us paying our share of some old PERS bonds just for the share of our staff who are covered by those bonds, who are part of the PERS city workforce, and the cost of issuing our tax anticipation notes every year, which kind of circles us back to fund balance. But those are the expenses of just having to manage our own fund. I'm just going to click through. Oh, sorry. Go ahead.
Oh, sorry. No.
Oh, okay.
It was just a lot of bubbles.
I know. I love. I don't know if anybody remembers this from last year. I made this slide last year, and I don't know. I just kind of fell in love with it. So I thought I'm not going to go over it. I'm just going to put it back up. Actually, another city employee was watching this presentation for some reason. I don't know why. And she immediately called me and said, "What is up with your weird abstract art bubble slide?" It's like, that thing is beautiful. What are you talking about? I actually like this slide. I do like this slide because it gathers all of the major assumptions in our expenditure budget in one place. You know, the blue dots are the major expenditure categories. And the sort of gold dots are all of the things we have to make assumptions about to build that budget. I mean, a budget is just a collection of assumptions. And wage increases are in the middle, and they're in red because they impact everything. Like, they're the only assumption that we make that impacts every single piece of our budget. But you can see, you know, these are the kinds of things we have to make assumptions about. And this also tells you the vast number of places things can go wrong as we are making assumptions. You know, wage increases, I'll just say a few words about those since they do impact everything, is that COVID and the city response to the economic impacts of COVID did not significantly impact sworn wages, at least as compared with elsewhere at the city. There was that delayed cost of living adjustment that I mentioned for PPA members, but then they should, as long as nothing changes, which I'm not privy to whether things will change, but they'll get a double COLA in the summer of 2021 and sort of catch up for that. But there was no change for PFFA members, Portland Firefighter Association, or Portland Police Commanding Officer Association wages. Still got cost of living adjustments and have gotten step increases, and no furloughs among sworn staff. So really the only long-term, there was the change of the deferred COLA for Portland Police Association members. But in the long run, the only real change was the pay freeze that also the non-represented sworn members had. There just aren't very many of those folks. So the changes that were going through the city with wage increases in response to COVID and the economic downturn didn't really impact the sworn population.
Can I just step in really quick? And I know you're speaking on behalf on how it affects Fpdr. I understand that, but just for people that are watching or listening or on the call, and I can't speak for anybody but the firefighters, but our firefighters gave back $4.7 million over 2 years with working more without getting paid and lowering the hourly wage. And there's a lot of things that our firefighters did give back. And while it's probably not going to affect Fpdr, there was a huge give back by the firefighters last year. And I just want to make sure that that's recognized.
Okay. So what Trustee Lyman is referring to is that the firefighters agreed to increase the number of hours that they work each pay period. So their hourly rate did go down. Am I saying that right?
Yeah, our hourly rate went down, but our hours that we work per week went up. So
Right.
we're working more for less, pretty much,
Right.
which in essence creates a savings for the city, and a savings over because we had our 40-hour staff did furlough, and so there was other things that were in there too. So I think it came out to a $4.7 million reduction over 2 years.
Right. So they're working more for the same, is what I should say, for the emergency operations staff, more hours for the same biweekly pay. And so since the pay is the same, for those folks, it doesn't impact our budget at all, because the pay is exactly the same. There should be lower overtime at the Fire Bureau because folks were working additional hours. That's the concept behind the $4.7 million in savings. So we might have seen a decrease in PERS contribution costs if it wasn't for everything else that happened this year with wildfires and all of those other things. And the 40-hour folks at Fire were given the option to either furlough or work a quote unquote free call shift. And so some of those folks, I think, did choose to furlough. All right. Let's see, did I have anything else I need to say about that? About my beautiful slide? I don't think so. I'm not going to go over this slide, but it's in the presentation because this gives actual values to many of those assumptions that were on the prior slide. And I just want to be really transparent about what we are assuming in many of those other areas, where I can summarize it neatly in a little chart for you. So you can judge for yourself how good you think I and the rest of the Fpdr finance staff are at the guessing part of our jobs. Although a lot of this guessing actually comes from Chair Harwood, or a significant portion of it comes from Chair Harwood, who provides guesses for the whole city on things like inflation. But let me know if anything jumps out at you on this slide that you want to talk about, or if you have any questions later on when you have more time to peruse. Okay, we're getting there. We're almost there. Now we're switching to revenues. Any other questions on expenses before I talk about revenues for a few slides? So this is a much shorter and simpler conversation because there are just a couple of pots that we get our revenue from. So this pie chart, as with the expense one, shows the total recommended budget for revenues for fiscal year end 2022, and the pie is bigger than it was last year, which you can't see. But what you really can see is that almost all of our money comes from property taxes. And if you consider that beginning fund balance is also really just leftover unspent property taxes, then property taxes are now 99.7% of our revenues. And that's up from 98% in the prior year. And the reason that property taxes are going to make up even more of our revenue source than they did in the current year or in past years is because of the loss of that overhead revenue from the police TriMet contract that I mentioned before, and also because interest income on fund balance has declined. Will be less next year, and already was a lot less this year than we expected it to be because of the decline in interest rates. So we'll spend a little bit of time, of course, talking about property taxes. So this chart, as with the earlier expense chart, shows you actual tax collections, Fpdr property tax collections in 1920, what we project we're going to get in the current fiscal year and fiscal year in 2021, and what we're budgeting for next year, and then what we forecast for beyond. So taxes are essentially a plug in our budget. We figure out how much money we think we need to spend on everything, and then we see how much beginning fund balance we have, and we see how much money we can raise from other sources, and the difference, what we have left has to be funded from property taxes. So with the decline in our other revenues that I already mentioned, the tax levy is going to have to fund more than 99% of our expenses next year. But I want to draw your attention to, if your attention has not already been drawn, that there is going to be a pretty significant increase in tax need next year in fiscal year end 2022. 25, we're going to need to raise another 25 million as compared with what we raised this year, which is about 15.4% more. So most of that we have been expecting for several years. It's not a surprise. if you look at last year's budget presentation, as I do when I build this every year, you'll see that we estimated that we would need 185.4 million in property taxes in fiscal year in 2022. And now this year we're saying we think we need 190.7 million. So most of that 25.4 million was predicted and planned. We always knew we were going to have a ton of retirements this year. We always knew PERS rates were going to go up. We saw most of this coming. And of course, you're never going to be exactly on, but 5 million of this we did not see coming. And that is a lot more than usual. But here's just another moment to thank 2020. The remaining 5.4 million that we didn't see coming is really caused by 2020. In the current year, short-term disability costs from COVID claims and the increase in PERS contributions that were driven by overtime, are going to reduce our fund balance that we'll have left over at the end of this year to spend next year. And then impacting both the current year and the budget year are changes at the Police Bureau, which are impacting that overhead revenue, but may also continue to drive even higher retirements than we were expecting. And then interest rates, that because of the economic downturn and the Fed will continue to hold rates at zero, we're not going to make as much money on interest as we have in the past. So that is where that additional 5 million that we wouldn't have seen coming at this time last year is coming from. And I'm not sure I made this totally clear, but we knew there would be a lot of retirements this year. We did not know there would be over 100 retirements this year. So we knew there would be many. We did not plan for the sheer volume of retirements that happened this year. So that is why we will have to raise the tax levy all at once a little more than we did last year. And on top of that increase in just needing more taxes, we will also have to gross up the tax levy more than we have in the past. And Matt and Scott and Chair Harwood were talking about this in the last presentation. In order to get that $191 million in taxes, we have to levy almost $212 million because we know we're going to lose a lot to people who can't pay their property taxes, to delinquencies, we'll lose some to discounts, and then we'll also lose some to compression. So that's why we've increased the delinquency gross up from kind of our normal rate is 4.5%. We've increased it to 6%. Our normal loss assumption for compression is around 4.5%. We've increased that to 5%. So we're also going to have to gross that levy up a little bit more than normal this year. In terms of the RMV rate, we're still fine. We all heard about that. We're at $1.15 this year, and we will go up to $1.33 next year. But that increase is kind of a mix of the increase in how much we have to raise taxes, but it's also related to the fact that we don't expect RMV to grow at all next year. And the assessed value rate that folks actually pay on is $276 this year, and we estimate it's going to go up to $311 next year. And that's with forecast 3% growth in assessed value. We are still projecting that assessed value will grow next year. So I will say, oh, yes.
So I guess I must have missed it in the past. So is that even in the valuation, the actuarial evaluation when you say you gross up what you actually charge based on what you expect compression and those other things to cause? So that is that part of the actuarial evaluation too?
Yes. So they talk with us in a lot of detail about the assumptions they should use for that. But yes, they gross up when you see that. They'll talk about the benefit payments, but then they'll talk about the final levy amount in dollars. And that final levy amount in dollars includes a gross up for these factors as well.
Okay, great. Thank you.
Mm-hmm. So I was just about to confess to one of my struggles with the Fpdr budget every year is that, when we do these forecasts and we do from time to time, even, we have the work the actuaries do for us, but we also sometimes do 10-year forecasts, is that we can usually see these bumps coming. We know that the tax levy is going to have to go up and up and up for many, many years, but it doesn't go up in a nice smooth line. It's bumpy. PERS rates go up every other year. There are years when a lot of people retire. That's very connected to 27 pay dates now. So we can tell when these bumps are going to happen. And so you kind of ask yourself, well, should we try to smooth the tax levy and essentially raise it at a steady rate over time? Or should we make sure that we're not sitting on taxpayer dollars that we don't need? We don't ask the taxpayers for money until we need it. And I have always come down on the side of we don't sit on taxpayer dollars and we don't ask the taxpayers for dollars until we need them. And in fact, the charter does specifically say that we can only levy taxes to pay for our expenses in the next fiscal year. So it may be more than just a personal preference on my part. But I did want to point out that there is another, you could manage this to try to have a smooth increase in the levy to some extent by trying to smooth out those bumps. But the consequence of that would be that you would raise more from the levy in some years than you actually needed in that year. But I always struggle with that a bit. And if the board has any thoughts on a preferred approach on that, given that we don't know, how much we could smooth it legally, I would always be interested in hearing any thoughts on that. But that is what we have been doing, at least since I've been in this position, is kind of just accepting the bumps, but not asking for taxpayer dollars until we know we need them. Because we could see most of this bump coming last year. All right. Other revenues, which we've already talked enough about, I think. So our non-property tax revenues have now shrunk to less than 0.5% of our total revenues. And nearly all of that comes from interest income on fund balance and that police overhead revenue that I've been talking about. And I think I've talked enough about those, but this graph does really show the decline. The blue part of the graph is, we call it interagency revenues because that overhead revenue passes to us through the police bureau. And a little tiny sliver, just like 45,000, also comes from the fire bureau. And that's in blue, and then in orange is the interest income. So you can really see that what we expect to receive in the current year is about 1/3 of what we've received in the past. And then it drops down to about 1/4, or maybe even a little bit less than that of what we've received in the past after that. So this graph is just a good depiction of that, I think. So this slide just again puts some actual figures to some of the assumptions that we've been talking about on the revenue side. Again, I'm not going to walk through all of this, but I do like the board to see the numbers that actually underlie all of those assumptions on the revenue side. So the first table has property tax assumptions. You can see what we're assuming for RMV growth, what we're assuming for AV growth, what we're assuming for losses due to compression in the tax levy, what we're assuming for losses due to delinquencies and discounts. For interest, you can see what we think our average daily cash balance will be. This is another place you can see our fund balance declining in fiscal year in 21. Our average daily cash balance is down to 49 million. What we think we're going to be able to get to earn on that fund balance in terms of an interest rate, and therefore what our interest income will be. And then some of the assumptions that go into forecasting that police overhead revenue, which are, how much will the wages be of police officers who are contracted out for other work? What is the overhead rate going to be? And therefore, how much revenue are we going to get? And I should actually say on that police overhead revenue, it's not just about it's mostly about the TriMet contract, but it's not entirely about the TriMet contract because most of the non-TriMet revenue from police comes from them providing security at large social gatherings like sporting competitions and community festivals. And of course, we're not having those and not expecting to have too many of those next year either. So those will rebound. But as you could see from the graph that showed the forecast over the 5 years, it's not going to recover to the level that we have been in the past. All right, finally, we're almost done. Before we wrap up, I do want to summarize the risks to the forecast. We've talked about these throughout. But it's a guarantee that the budget will not be 100% accurate and the forecast will not be 100% accurate, but it's really important to be clear about the places where there is unusual amounts of uncertainty, and particularly where higher levels of uncertainty collide with high dollar items, because that's where we really, we run the risk that we will produce expenses or revenues that are significantly different from what I've just walked you through. So we've already hit on most of those. So this is just a quick recap. On the revenue side, we've talked about the only risks that really rise to that level of high uncertainty colliding with high dollars are concerns around delinquency and compression. We've already talked about that. You know, delinquencies and compression, they could be higher or they could be lower. We will see. On the expense side, you'll see that the first three risks, all of which we've already talked about, but they're all related to the police bureau, the first three, which is, you know, police bureau retirements for next year. We are budgeting only 10 police retirements for next year. Is that really going to happen? You know, we think so because so many of them retired this year, but we don't know that for sure. Police bureau hiring. We have taken the police bureau at their word that they are, you know, there's been no hiring in the current fiscal year, and they have told us that they're only going to hire 40 folks in fiscal year 21-22. But I think that given how many retirements they had this year, it's possible they could do more hiring than they think they will right now, despite all the sort of political and financial obstacles to that right now. So I think that's a risk. The contract, the police association contract, well, we're used to seeing open contracts. There's pretty much at least one every year. So that's not an unusual risk, but because, you know, wages impact so many things, wages being either higher or lower than we have assumed, that's always a risk to the forecast. That's worth calling out. And finally, PERS contributions. So PERS contributions are only a risk for the out years because the contribution rates are set. I mean, PERS contributions can be different from what we budgeted because of overtime or, you know, folks making more or less money than we forecast, or slower or faster hiring than we forecast. But the PERS contribution rates are set for fiscal year end 22 for the year we're talking about and the year after that. But in the out years, it's a risk what they will be. And I think it's worth calling out this year because for two reasons. One, our budget is more and more vulnerable to changes in contribution rates because PERS contributions are making up a larger and larger share of our budget. But secondly, because we are in a place of great economic uncertainty, which makes the stock market even more unpredictable than usual, which makes PERS investment returns harder to see than usual, which makes PERS contribution rates harder to predict than usual. So those are the risks that I just want to make everyone cognizant of. Last slide is just to wrap up by kind of hitting the key takeaways one more time. I feel like I'm teaching a class or something, like I'm going to quiz you all on this. Maybe I don't need to wrap up, but I think it's worth doing. So, kind of the four main takeaways I would say from the budget this year are first, that we retired and continue to retire record-shattering numbers of sworn employees this year. And we've talked throughout this afternoon, sorry, that's my dog barking in the background. We've talked throughout this afternoon about all the different ways that is impacting the budget. But at a 30,000 foot level, what it means is that we just made a big lurch toward that moment of peak expense when all of the sworn workforce will be Fpdr 3 and all of our Fpdr 2s will be retired and drawing pensions. So we just, this year we just hit the gas pedal on that transition. But we're going to take our foot off the gas next year. So I don't know that at the end of these upcoming 2 or 3 years we'll be any further along than we would have predicted. But in the short run, we've kind of made a big lurch on that. The second big takeaway is that we have actually talked more about the revenue side than usual this year. We've always kind of been able to take the revenue side of things for granted. And that's partly because there's been some change. We've lost most of our non-property tax revenue, some of it permanently and some of it temporarily. But on the more important property tax revenues, we are entering a year or a few years of greater uncertainty about delinquencies and compression and how all of those things will interact and impact the levy. So we've made adjustments that we hope are adequate. I will, as a side note, say that the adjustments we made to the tax levy late in the game last year for the levy this year seem to have been adequate. Tax collections are coming in pretty much on target. So that gives me hope that we're going to get it right for next year, but this is also a moving target, as Chair Harwood has mentioned. Third is just continued fallout from this new world that we all live in. I'm willing to bet that almost all organizations are talking about these three things as they look at their budgets. the pandemic, the economic downturn, police reform, but FPDR is really kind of uniquely positioned to catch whiplash from all three of those things. And we've already seen the impacts this year. We've been able to identify the various ways that we're being impacted, which are listed in that third ribbon, but we still don't know the extent of the impact, and we can't see the end of the impact yet. So we're in the middle of this right now. And the fourth takeaway that I would like you all to leave with is knowing that FPDR, that I'm going to manage this financial risk conservatively. I'm recommending a reasonably conservative approach to managing the risk, by which I mean erring on the side of not running out of money. And I've kind of listed 3 examples of how we're managing risk conservatively as we go through this, but in a way that is, I hope, conservative but reasonable and not alarmist at the same time. And that brings us to the end. Thank you all for listening to 2 very long presentations today, but on important topics. So questions, questions and or changes to the budget that the board would like to discuss. I'm hearing no questions. All right, we must have answered them as I was going along.
You apparently have our implicit trust, Stacy.
Or maybe I just, or I like just, you know, I beat you into submission by droning on for 30 minutes and at the end you're just like, fine, we'll adopt the budget.
Oh,
I will tell.
Go ahead.
We have a public comment by Mr.
Okay.
We have a public comment from Mr. Jimkowski.
There is public comment?
Yes. Mr. Jimkowski has signed up for public comment.
Okay. Go ahead, Mr. Jimkowski. Mr. Jimkowski, are you there?
Yeah. Hello, can you hear me? Oh,
Can now, yes.
okay. Thank you. I was muted there, I believe. Okay, thank you very much. If I may, very in like 15 seconds. Director Hutchinson, you commented about the legal review, and initially that was an agenda item for January 2020, and it involved Mr. Luchin and Mr. Dahlhauer, as well as Mr. Stevens and myself. If that's going to be another meeting again with no public comment, and I suggest that Mr. Stevens be replaced by Mr. Henry Gripper, so you get a police perspective, if we're going to still be invited to the meeting or not. I don't know. It's up to you, sir, if we are. I know I'm still interested. I believe Henry's interested. So if that's possible, please consider that.
Thank you, Mr. Jimkowski. Josh and I are going to talk about what this meeting comprises of and who will be there, and we'll let you know.
Thank you. And then thank you. My question to Stacy. Stacy, my question was initially raised by Trustee Lehman at the May 2020 meeting, and I didn't hear I never found the results yet, but a comment was made that you reported that the FPDR was members are better off in retirement than PERS members. And then Trustee Lehman asked you, I paused for a minute and asked you where you got the data from, and you stated you got it from PERS website or PERS, something like that, and that you would get the report to him. Was that report there presented? If it was, how do we get a copy of it? Presented. When will it be presented?
Mr. Jimkowski, it's a little hard to remember what that,
Select from disk not ejected prop.
Oh, what that specific question was at that specific, board meeting. Or what I was specifically referring to, however many years ago. But most likely it was the ETOB test. Or perhaps I was talking about the actual, defined benefit formula for PERS.
Not taking more time. I can send you an email on it if you don't mind.
Okay.
Thank you. Thank you very much. Thank you. Thank you for the time.
Alert from disk not ejected properly.
Sorry.
That's not me, I swear.
That was she and my dog barking too. So.
Oh, our dogs are talking to each other.
Yes. She heard your dog.
The trials and tribulations of Zoom calls. Um, so if there aren't any other questions for Stacy, we'll entertain a motion to accept the budget as presented.
I'll make a motion. We accept the budget as presented.
I'll second.
Excellent. So we'll do it the same way we did last time. Any objections? Seeing none, the motion passes. And we move on to what I imagine will be a relatively quick final item around Milliman's contract. I'm not sure who's taking this, if it's Stacy or Sam or who's going to take it, but I'll pass it along to them.
It is still me, and I will be quick. I promise. So what you have before you is a resolution to extend and amend our actuarial contract with Milliman, who you just heard from earlier today. So you know who they are, and I think you all know generally what they do for us. We've had a contract with Milliman since 2013. It's already been extended once, but it will now expire on March 31st of this year, March 31st, 2021. I had originally planned to do a full RFP and award a brand new contract right about now, but given the many challenges of the last year and the truly excellent service that we get from Milliman, we would prefer to extend their contract for another 2 years to March 31st, 2023, and then conduct a full RFP process and award a new contract at the end of 2022. You know, Matt and Scott, who are our folks from Milliman, they really know our plan inside and out, and we have a truly unique pension plan. And they also understand and are capable of conducting that tax levy analysis, which is, you know, not something that actuaries walk in the door being able to do. And then they are also the organ PERS actuaries, which is a useful overlap for us. And they have always been excellent and thoughtful to work with. I certainly have no concerns with extending their contract for this 2 years, but I do want to do a full RFP process at the end of 2022. So in addition to extending the contract for those 2 years, this amendment would also add $40,000 to the not to exceed amount and increase pricing for the various things they do for us by an average of about 4%, which I think is perfectly reasonable, given that prices haven't been increased since 2017, which was when we last amended their contract. And I'm happy to answer any questions.
I don't have any questions, but I can concur with everything you said about them. I think they do provide really excellent reports. They're on top of what's going on with the plan and the levy analysis. And as you pointed out, their understanding and work with organ PERS is really invaluable. So I think they do a great job.
I'd like to agree that I think they do a great job too. The concern I have, and it's just like when we were talking last year about benefit adjustment and people, you know, shared sacrifice and optics. I'm just kind of curious why we're just adding a 4% adjustment to this. Was there any negotiation as far as talking about less or something that fits? I don't know. I'm just curious where we're at on that, or if there was a negotiation, any type of
Yes. So we did negotiate for about the last, you know, I guess we wrapped up negotiations maybe 3 or 4 weeks ago, but we were negotiating over the 4 to 6 weeks before that. So inflation over that time period, since we raised prices, has been about 13%. And so this is significantly below inflation in terms of, if we were to pay them the same in 2017 dollars, we would be increasing our prices by what we paid them. They would be increasing their prices by about 13%. I can kind of pull up the specific items if you guys want. So instead, we're just increasing by 4%.
So their contract was, I'm just trying to remind me. So the original contract went from when to when?
It went, let me just pull it up. It went from 2013 to 2017, if I remember right. But let me pull it up so that I get all the detail. This is a nice thing about Zoom meetings. You have your computer right in front of you. You can pull up all your stuff. Let's comparison. So the first contract, oh, I don't have the dates with it here, but it was from 2013 and then it expired. So I think it was July 1st, 2013. and ended on March 31st, 2017. And then contract amendment 1 went from April 1st of 2017, which was the last time prices were adjusted, to March 31st of 2021. And now this contract amendment would go from April 1st, 2021 to March 31st, 2023.
Was there any adjustment between the first contract and the second contract?
So there was an adjustment in 2017, yes.
What was the adjustment?
So if we are, I just have the comparison between how prices are now, right in front of me anyway, how prices are now, and then what they're going up to in Amendment 2. So inflation since 4/1/17 has been about 13.2%, and their price increases range from 3.33% to 6.25%, kind of depending on the service. On average, it's 2.5%. No, that's average annual inflation. On average, yeah, about 4%, a little over 4.4%. But I'd have to pull up and look, and then pull up the individual price increases on the original contract. I don't know how much of a contract bump or a price bump they got in 2017. Not off the top of my head, anyway.
Yeah, well, I'm assuming that you guys went through all this already and took these things into consideration, because I have no idea. I don't have any of that in front of me. I just want to make sure that we're not just in these times, as we say, we're talking about all the risks that we see here, and not that this is a huge one, but in proportion, we're given a 4%. Now, if it's over 3 or 4 years, I understand. If it ends up being 1%, then that makes sense to me. But so I just wanted to point that out and make sure that was addressed and looked at, because I will accept your recommendation here, because you guys did the work, and I trust that you do the due diligence. So I just wanted to point that out.
No, but I really appreciate the question, because you all obviously wouldn't be, doing your job to oversee these things if you didn't ask those questions. And so I'm sorry I don't have the original. It didn't occur to me about the original contract, since I was just looking at the comparison of the contract we're operating under now and the price increases we're looking at. And just to give folks a flavor, so right now they charge us $37,500 for a plan valuation, and in the contract amendment, in this 2-year extension, they would charge us $39,000. Actually, I think you guys do have those in front of you, because those are, listed in the contract. They charge us $15,000 for the levy analysis. In the 2-year extension we're talking about, it would go up to $15,500, and so on. Actually, the biggest percentage increase is in what they charge us for DRO calculations, which they currently charge us $800, and they want to charge $850 in the future. And we did land on a bigger price increase in that, although again, it's still not even remotely close to inflation if we were looking at inflation over a 4-year period. But that DRO calculations have become more complex with the changes in the tax offset benefits and how those are figured into DRO calculations. But we don't have very many of them. It's also the thing that we spend the least amount of money on in the actuarial contract. But certainly, I do want to do a full RFP process at the end of 2022, because Milliman will have been our actuaries for 10 years at the end of 2022. And they, as I said, bring a lot of expertise that I think will be hard to replace. And so we may, anyway, we want to take a look at everything that's out there and do the full RFP process.
Anything else for Stacy? All right, I'll entertain a motion then to accept the contract amendments.
I'll move to accept the contract amendment from Milliman.
I'll second.
Great. Any objections to accepting the contract amendment? See none, it is accepted. Stacy and Sam, anything else for us today?
Just all I'm going to do is a real quick recap of what we're going to do in the next couple of board meetings. So in March, we're going to start to talk on the Fpdr2 benefit adjustment, the COLA. We'll also probably do just a quick review of all the COVID claims, what's happened and the impact, as I sent you all the graph out there. You saw the huge spike in the fire claims, and we'll just go over what that is, how many claims, costs, etc. And also the legislature has kicked off and they will continue to operate, I think, through June. And so we'll do a recap in March of where we're at with different legislation that may impact Fpdr and its status. That's all I have.
All right. Anything else from anybody?
I have one quick question.
Yep,
I'd like to verify, have there been any COVID related deaths amongst the police or fire?
No.
I'm glad to hear that.
And Kim can correct me here, but we've had no long-term COVID illnesses either. Correct, Kim?
That's correct, Sam.
Very good news.
All right, Ms. Jimkowski, you've got just a minute here.
I'm all finished. Thank you for your time. I appreciate your time. Thank you very much for giving me the opportunity to ask questions. I'll email Stacy, and I can follow up with Sam about the legal review. Wait for his decision. So thank you.
Okay, thank you. Anything else for the good of the order? Thank you, everybody, for your attention to this. I know it was a long meeting. Lots of information, and we will see you next time. At this point, let's adjourn, and thanks. Good to see everybody.
Take care.